The Fed is putting pressure on the economy, more pressure than frankly is needed to get inflation down.
I think the Fed wants alacrity of a decision one way or the other so they can get off the pot.
We've learned collectively how interest rate insensitive the U.S. economy in particular has become.
I would say the rates policy is definitely restricted.
I do think that they are restrictive, but I think it will flow through to the economy over time, and they can take out some insurance rate cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance coming into Wednesday at all-time highs on the S&P 500. 3-day winning streak, 24th record close of the year so far for 2024. And the main event of this earnings season is coming right up. A $2 trillion market cap. The name is up year to date by more than 92%. It can only be one name, Browne, Nvidia.
This is what Jim Reed over at Deutsche Bank called it. The most important macroeconomic event, or one of the most important events in the macroeconomic calendar. That is where we're at, where one name, one company can dictate the macroeconomic backdrop for an entire market, and that's today.
The South Side raising the bar once again, going into the numbers a little bit later on this afternoon. Barclays raising their price targets. Stifel doing the same thing this week, expecting what? Beat and raise, Annmarie, beat and raise.
Well, a lot of the question has to come out to, it's not about do they beat expectations, by how much. The bar just continues to increase for Nvidia that they need to clear. Catalyst Funds says this: to avoid a sell-off, the company will have to top profit and sales estimates by at least 15%.
Not just about Nvidia this morning, it's about Target, or as TK would call them, Target. Target.
It's actually
Target.
Okay, Target is what people call
Target
it because it's the upper sort of crust of that ilk of store, which maybe they want to get away from.
Target it is this morning. We're down by about 0.2% in the pre-market. This is the communication we've had from the company so far. So we're going to get price reductions on 5,000 goods. Look out for announcements around that again. I imagine they'll give us some more detail and colour on that in the release a little bit later this morning. But the quote that stands out, I think, for us all, we know consumers are feeling pressured. Just last week, Walmart executives, we're seeing customers trade into Walmart. Just yesterday, Macy's. Lisa, assuming customers will continue to be discerning. This is a theme right across retail.
The problem with it, and this is what I think everyone's struggling with, and frankly, the profound uncertainty that we have with the consumer, slowing but not slow, softening but not soft, the idea of more discerning but still spending dramatically. And that's really the key question, is how much is this really a statement on why some of these companies are shifting their product mix rather than sort of projecting weakness in their earnings?
Mohamed El-Erian out with a piece 30 minutes ago talking about the risks with the Fed being so data dependent. And one of those, he says, is the concern of the data dependence Fed comes with the risk of them is growing, that a number of companies expressing concern about weakening consumer demand. And that is particularly the case for those serving the lower income households, where pandemic savings, all of that has been depleted.
So that's what you've got to look for earnings. So a little bit later this morning, in the next hour or so, we'll hear from Target. After the close, a little bit later this afternoon, we'll hear from Nvidia. We'll also hear some Fed speak as well. Goolsbee a little bit later, and the FOMC minutes a little bit later this afternoon too. Governor Waller, the standout. Lisa talked about it at the start of the week. The standout for me from the Governor Waller comments in the last 24 hours, the fact that he graded the last inflation report and only gave it a C+. A C+ for an inflation report that this market got very carried away with.
It's passing, but it's not great. Basically, nobody is happy with the C+. And that's the reason why he said that they need to see several more months of good data, not necessarily C+ data, but maybe C data, that can give them the confidence to cut. This was a theme, though, throughout all of the Fed speakers. None of them are comfortable really talking about rate cuts in the near future, with the idea maybe we're talking about maybe one this year. So I wonder how much the market comes around to this versus just sort of thinking they're just basically shooting darts at a dartboard with a blindfold on.
C+ stood out to me as well, because that is a grade that would be unacceptable to my parents. And he says far from failing, but not stellar either. But what Claudia Sahm did yesterday in the confidence they need, what is that actually defined by? She said 3 months. Several more is what he says. This pushes the timeline well past the election, what I'm looking at, and definitely towards the end of the year.
Governor Waller and others on the committee seem comfortable with where policy is right now. Doesn't mean they're going to cut anytime soon. Certainly doesn't mean they're going to hike in the next few months. This line from Governor Waller yesterday: we're not seeing anything right now that looks like staying here for 3 or 4 months is going to cause the economy to go off a cliff. Would they respond to weaker data? Absolutely. Are they expecting it to fall off a cliff? No. Andrew Hollenhorst of Citi later on this hour. We continue to expect the first 25 basis point rate cut in July. July's just around the corner. June's only next week. What do we need to see between now and July for Andrew Hollenhorst of Citi to ultimately be right and we get that first cut just a month or so away?
That's my first question to him. How much do Governor Waller's comments change his view, given the fact that they've set the bar a lot higher, and given the fact that we're just not seeing it in the data? We don't have the luxury of 3 months of data before July in order to get that confidence. What kind of weakness would you have to see to get other people on board with that kind of view?
They're three of the big themes for us this morning. Let's turn to the price action and get to the scores on the S&P 500. Equity futures shaping up as follows. This is what we look like. We are negative by only 0.1%. In the bond market, yields are higher by a couple of basis points at 4.4335. I want to sit on foreign exchange just for a moment. We'll start with the euro and then we'll move on to what's happening with sterling. Christine Lagarde, ECB president, saying this about inflation. We're confident we've got inflation under control. That's not what you're going to hear from the Bank of England after the print we got earlier this morning. That's not what you're hearing from FOMC officials either. The ECB, out of the big central banks worldwide, seems to be in quite a unique spot at the moment where they're able to commit to their next move and commit to this idea that they think they've got inflation, price pressure under control.
They also have the lack of a luxury of Germany that's been basically in recession, that basically you've seen a lot of pockets of weakness that have been dramatic. And that is either a luxury or not, but they're catering to that. And that's a more obvious area to cater to than, say, in the United States. The UK is in its own world of hurt because the economy isn't that great, but the inflation isn't coming down nearly enough. That's going to be actually a mystery to me, but Europe actually seems like less of a mystery, with the weakness offsetting some of that inflationary pressure.
Let's turn to the UK just briefly. 127.32 on sterling at the moment. We have got a stronger pound by about 0.2%. Inflation out early this morning, upside surprise. If you were looking for a cut in June, I think the bias in the City of London now shifting towards later on in the summer, perhaps even August. I want to return to Europe. Think about the growth policy mix in Europe. The growth policy mix was absolutely dreadful in the last 12 months. You talked about the recessions in certain countries. That was at a time when the ECB had to remain committed to high interest rates. Now you could make the argument, and Erin, Browne of PIMCO is going to make that argument later on in the programme, so look out for it, that the weakness is behind us. And they're going to start cutting interest rates into the recovery in the Eurozone, which is why some people are starting to look at non-US DM equities. Look abroad, look to Europe.
They've been talking about that all year, and guess what? It's worked. I mean, if you take a look at the stock 600, it has outperformed the S&P 500 by a dramatic margin. A lot of people are also talking about the fact that now Europe is talking about industrial policy akin to what the U.S. is. So they're going to be stimulating on both fronts. How much is that going to be the case?
So let's talk about industrial policy and the prospect of tariffs on the European automakers. That was the standout overnight. Just a little bit of a teaser of China's reaction potentially to tariffs that might come through from Europe.
And that's exactly what it was, a teaser, because the China Chamber of Commerce went to the European Union, went on Twitter and says it was informed about this potential move of tariffs by, quote, insiders. This would affect U.S. and European auto companies, Jonathan, those goods going into China. China is signaling that it's ready to unleash these tariffs as high as 25%. This just sets the stage for not just tit-for-tat Washington, Beijing, but for tit-for-tat Beijing, Brussels.
We've talked about this a few times, what Mercedes-Benz is saying on the record and maybe what they're saying behind closed doors. I wonder what Mercedes-Benz is saying both on the record and behind closed doors if this happens.
Right now you're seeing the shares decline. But to me, who has the bigger leverage here? Who's importing more cars? Where do Mercedes-Benz and BMW get most of their revenues, or 40% of their revenues? China, which raises the concern of retaliation having a bigger bite than even some of the tariffs, given what the imports are from China right now into Europe.
Well, the BMW chairman recently said, we do not want to shoot ourselves in the foot with these kind of tariffs, kind of warning the European Union. But Lisa, John, you brought this up a ton of times. What do they say publicly? Because they want that access to Chinese markets. And then what do they say behind the scenes?
Yeah, I imagine they want the walls up domestically, but at the same time, they want to maintain access to what's happening in China. Bottom line, can they achieve that? I've been saying this for a while. Can you continue to sit on the fence and entertain Chinese markets at the same time as maintaining a presence in places like Europe? I think it's going to be really, really tough for companies to do. They're going to have to pick a side. They're going to have to pick a side in the years to come. That's what a lot of people think.
How does Olaf Scholz say basically, hey, you automakers, you're going to have to deal with weakness while we try to put up those walls? I don't really understand how this is going to happen. And if they don't, what does that mean if the fact that China is overproducing so many electric vehicles at cheap rates? What does that mean for their auto sector long term?
A lot to talk about this morning. Let's begin by getting you some stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. UK inflation came in hotter than expected, in part due to continued price pressures at restaurants and pubs. It was just 2.3%. That's the smallest increase since 2021, but that's the upper end of where forecasts were at. And just yesterday, BOE Governor Andrew Bailey said that he expected quite a drop in the inflation prices. Nonetheless, investors have pushed back cut bets. Now less than 2 are priced in for the BOE. TikTok has told employees that it plans to lay off staff in its marketing and operations teams this week. That's according to a report in The Information. The exact number of job cuts isn't known, but unlike other tech giants, TikTok rarely conducts large-scale layoffs. But at this moment in time, TikTok is grappling with an uncertain future facing that law, which will ban the app in a year unless it divests from its Chinese parent company, ByteDance. And Barclays is the latest Wall Street firm to consider asking its workers to get back to the office 5 days a week. Some managers have already started warning employees to prepare for the daily commute, that according to sources. Now, the decision comes after FINRA announced a series of requirements set to take effect in coming weeks. That includes requiring brokerages to list some home offices in regulatory records. And that's your brief. John.
Danny, thank you. Surely I'm not the only one who read that story and thought this. There are people at banks that aren't in the office 5 days a week. That's still a thing.
Well, I think that actually there's certain places where that's their one selling point. But you're right. How many people are surprised by this, saying, really? You have to actually go to the office?
Well, what I love is that they're doing it because of FINRA rule change, not because, well, the pandemic's over. Get back to your desk.
I thought everyone was back in the office. Maybe that's just me. Sort of conditioned by my own brutal experience of being in the office every day.
You hated being at home. Come on.
Couldn't stand it.
Okay, so that's it.
Absolutely couldn't stand it. Up next on the program, Biden closing in on the swing states.
Folks, the threat that Trump poses is greater in his second term than the first.
I talk about him differently now because now the gloves are off.
The gloves are off. That's next from New York City this morning. Good morning. Equities on the S&P 500, another all-time high close in yesterday's session. Equity futures right now down by 0.1%. Yields higher by 2 basis points. The 10-year 443.55. Under surveillance this morning. Biden closing in on the swing states.
Folks, the threat that Trump poses is greater in his second term than the first. It's clear that when he lost in 2020, and I mean this sincerely, something snapped in Trump. He just can't accept he lost. And he lost it.
The whole world is laughing at him. He's a fool. He's not a smart man. He never was. I talk about him differently now because now the gloves are off.
So here's the latest. Former President Donald Trump's lead in key battleground taking a small dip as President Joe Biden narrows the gap. The two are separated by no more than 2 percentage points in Michigan, Pennsylvania and Wisconsin, according to the latest Bloomberg Morning Consult poll. Jennifer Flitton of Invesco writing this. Like 2020, this presidential election will likely be decided by less than 10% of voters in the battleground states of Arizona, Georgia, Michigan, Nevada, Pennsylvania and Wisconsin. Jennifer joins us now for more. Jennifer, going into year-end, going into November, what are the policy options that the White House has left? What levers can they pull?
Well, I think they just did one this past week in announcing the release of oil reserves. They're going to have to try to find some way of affecting those prices that people are feeling when they go to the gas tank, when they pay for the food, when they're looking at their mortgage rates right now. The Fed isn't very helpful. And so this administration is going to have to do things that at least allow for the feeling of the economy loosening, right? For folks to feel like more is in their pocket. Because right now, compared to 3 years ago, everything just costs more.
Jennifer, one policy lever potentially the White House may pull again, they did this morning, and this has to do with student debt. Does that resonate with the electorate?
I think it depends on who is affected. And sometimes it actually sort of alienates those who don't go to college. We sometimes forget that there's a huge segment of the population of people who don't go on and further educate themselves post high school, and those blue collar workers or small businesses, entrepreneurs sometimes, those folks aren't affected by that. And sometimes there's a disconnect between those who feel like they're paying for those student payoffs and those who are actually receiving them.
Looking at Michigan, Pennsylvania, Wisconsin, it is very, very tight. And our latest polling data shows that amongst a slew of other polls that have come out in the past few weeks. How critical are these three states to Joe Biden? I mean, can he even win without holding the blue wall?
Yeah, that's an excellent point. That is exactly what he has to do. I mean, his pathway to a second term is through the states of Pennsylvania, Wisconsin, Michigan, and then biting off one of those Sunbelt states. And it's sort of the reverse for Trump as we're looking at these polls, that his best route is probably through Nevada, Arizona, Georgia, and then biting off one of the steel belt, the northern states. So, this is where their focus is going to be. And we're 166 days away from the election. We know it's going to tighten, and it's going to tighten further once folks really start focusing, which is when the kids go back to school in September.
Jennifer, a lot of people have been talking about not voting at all because of Israel policy. At least we hear a lot of articles about that. We hear a lot of people saying that vocally. Are we overstating just how significant this issue will be to getting voters out or keeping them home in some of those blue states, in some of those swing states?
Yeah, yes. I think once you do the crosstabs, I mean, you're going to find demographics. You're going to find people, swing voters sometimes are those who are willing to swing, progressives, young people. These are folks who aren't necessarily going to go and vote for Trump, but they may stay home. They may have their vote depressed. And that really matters when you're in a state like Michigan, and you're 10,000, 20,000 voters that you're really pining for. But I think the fundamentals of this election are still staying true, and we're seeing this in polling. It comes down to the issues of inflation and immigration, crime, and then on the other side, abortion and sort of that democracy chaos sort of issue on the Democratic side.
Is there anything the Biden administration could do around inflation, given the fact that it might be actually decelerating, but the inflation that's baked in isn't going to change between now and the election?
Some suggest that it may be about messaging and having a better message and looking forward to the future. But I think you've hit on the question, and that's the question that the Biden campaign are wrestling with, sort of constantly, and they probably will up to Election Day, especially if our economic circumstances and the way that people are feeling the economy stay the same.
Jennifer, forgive me for the home bias, but I want to talk about financial regulation and the future of it as well. The head of the FDIC is stepping down. We can talk about the why. The bank lobby, or the common sense lobby, seems to have won out over capital requirements potentially being unveiled over the next several months as well. What do you think the future of financial regulation is going to be, regardless of who wins the White House come November?
Well, and I'll first say that Mr. Bloomberg has announced that he will resign, but he'll step down only when his seat is filled by a confirmed new director. So, our chairman. So I do think that we may have a little more time with him. And then, of course, the bank lobby, to your point, there is a real push to get a reproposal. And I think the FDIC and OCC would potentially just like to make some minor changes on the Basel III issue. But the Fed seems to be a little more open to reproposal. And you're going to see Congress continue to push on this issue. There have been some really interesting hearings where you've seen some bipartisan concern with the proposal and the request for reproposal. So I think this is going to continue to play out throughout the rest of the year.
Do you think we'll see anything substantial when it comes to this ahead of the election?
Well, if I had to sort of armchair sort of, look at this issue as the likelihood of the time that we really have here in Washington prior to the election, I think it's unlikely. But I do think it's very possible that we see a reproposal. I know that many folks downtown and those who are on the Hill are constantly working to see that happen.
Jennifer, I know you focus on policy, and one of the biggest policy fights next year is going to be taxes as well, in terms of the financial umbrella. What are you expecting in terms of the extension of the Trump-era tax cuts? At what level do you think they get extended?
Well, and no matter who is president next year, you're right. In 2025, we have a number of provisions that are expiring from the TCJA. It was passed in 2017. It's going to look very different depending on the makeup of Congress and the presidency. So much is riding on this election as it relates to tax. And so if you do have say it's a Trump presidency with a majority in the House, for a Republican and Senate, then you could have a much larger sort of reconciliation package on taxes, something similar to 2017 in its breadth, right? But if it is a Biden presidency and you have a split Congress, it's really going to have to be a negotiated package because you have a number of different provisions from SALT to the individual tax rates and child tax credits. Those are all going to be part of the negotiation. So it's going to have to be a bipartisan package.
Jennifer, we're about 8 minutes away from the expected release of Target earnings. And this comes at a time when, just to go back to your point earlier, it's going to be really key at this White House to see what kind of messaging they can do to make people feel better about the fact that things are more expensive than they were 4 years ago, 3 years ago. The White House came out with this on Monday, basically calling on grocery chains to lower their prices, welcoming the fact that Target had lowered prices, saying they are delivering. Is this what will win when it comes to messaging?
Yeah, that's a great question. I think we saw this in the State of the Union, this whole idea of shrinkflation and sort of forcing the issue onto corporations, onto those who deliver services, onto those who deliver goods. I don't see that is where Americans are focusing their concern. And I do know that, as far as institutions go, grocery stores are pretty high in the support of the American people. Institutions in Washington, much lower. So I think that might be a difficult one to sell to the American people.
Jennifer, thank you for your input this morning. Jennifer Flitton there of Invesco. This is still the number one issue, isn't it, going into November?
Well, looking through the poll data that we have with Morning Consult, the economy rates number one. And then when you ask respondents, name three things about the economy that you care about, prices of goods is still a concern. What's interesting about this is the Biden administration met with a ton of executives in October. The Target CEO was one of them. The Target is cutting prices because they see that they have to for their business. And so potentially you're seeing weakness in the consumer. The White House is trying to act like Target is cutting prices because of the outreach from the West Wing, which is not factual.
Well, let's talk about Walmart in the last week or so. Why is Walmart getting business? Walmart's getting business because of what they call trade down. And if you're thinking about trade down from what? From who? We're thinking about Target, which is why these numbers later this morning are so important. What kind of damage have the Walmarts of this world done to their model?
They might push back against Target and say, we want to be Target because we don't want to be the high-end model. I wonder if it's Target or I wonder if it's Whole Foods. I wonder if some of the people who are trading down are going from more expensive grocery stores versus a comparable type of store. But that's true. People are looking to be cost conscious. So they want to compete. You're raising skepticism. Maybe this wasn't because of the White House meetings. You can make your own conclusion, but this is what they're doing.
I'm guessing it wasn't because of the White House meetings. The stock is down by about 0.4% in the pre-market. Look out for those numbers, expecting them at some point this morning. Look out for David Malpass as well, the former World Bank president. Annmarie caught up with him in the last week or so in the Wall Street Journal, just how busy things are going to be for the next administration. They've got to hit the ground running. The suspension of the debt limit expires January 1. This year's spending bills will likely be extended just long enough to kick the can into 25, and tax rates will rise at the end of 25 unless Congress and the president can agree to extend some of the expiring provisions in the 2017 Tax Cuts and Jobs Act. That was David Malpass in the Wall Street Journal in the last few weeks. So we'll pick up on that conversation later this morning. Coming up very shortly, we'll catch up with Geetha Ranganathan on the cuts coming to Disney and an update on the return of the bundle. That conversation just around the corner. Equity futures on the S&P 500 pulling back just a touch. We're down after closing at all-time highs in yesterday's session. Equity futures negative by 0.1%. From New York, this is Bloomberg. Live from New York, welcome to the program. Equity futures on the S&P 500 negative here by almost 0.2%. We're pulling back on the Nasdaq by 0.2% also after closing at all-time highs in yesterday's session on both the S&P 500 and on the Nasdaq. Who's counting? We are here at Bloomberg. 24 record closes on the S&P 500 so far in 2024. In the bond market, here are the yields for you, the scores. 2-year, 10-year, 30-year, shaping up as follows. Yields bleeding a little bit higher, up 3 basis points on a 2-year to 4.86, on a 10-year at 4.4395. Just getting numbers from Target. So let's switch gears and get to that. This is their outlook now. They see second quarter adjusted EPS in a range of 195 to 235. The estimate 219. Lisa, the guidance coming out of the company, listening to what some of the executives have got to say, we remain cautious in our near-term growth outlook.
Yeah, and their full-year adjusted earnings per share expectation is within the sort of lower range of what was expected, $8.60 to $9.60 versus the estimate of $9.44. But the comparable sales were actually lower on the first quarter, down 3.7% versus the estimate, down 3.68%. To me, this doesn't scream of the strength that we saw at Walmart. And I really want to dig under the hood to understand what the cost cuts have done to their margins, because that was one of the biggest questions.
Yeah, the range is just about in line. The numbers are just about in line. But Lisa, to your point, the outlook isn't convincing. Target's down by 3.7%. And the numbers land a few days after we've heard from executives that they're cutting prices on 5,000 goods. It's clear that companies like Target do not have the pricing power they once had coming out of the pandemic.
And for them, in line is a miss. And that to me is interesting because so many people have questions over how much they can compete with the likes of Walmart with all of their online offerings. I really want to understand whether this is an execution issue, whether this is a branding issue, whether this is just simply what has gone on with management, or whether this has to speak to the broader consumer.
The chief growth officer talking about discretionary spending on the call, likely to remain under pressure in the near term, adding that demand for home products, appliances is staying soft. They say continue to search for value. We've continuously hear that, not just from Target, Walmart, consumers searching for value and discretionary spending. They're starting to get a little bit more judicious about.
The stock was up 9% year to date. It's down by about 3 or 4 at the moment in the pre-market. Looking at the communication we've had from a range of names in retail over the last few weeks, I'll share some of it with you. Annmarie just went through what we heard from Target. This was Walmart. We're seeing customers trade into Walmart, trading down. This was Macy's, assuming customers still continue to be discerning in the year ahead. This was Starbucks. We continue to feel the impact of a more cautious consumer. McDonald's, the consumer is certainly being very discriminating. Target's down, Lisa, in early trading by 6%.
How much is this the new currency headwinds, though? Strong dollar. How much is this basically the blanket coverall as companies try to navigate this? And I say this because while all of the rhetoric has been similar, the actual performance has been different. And this, to me, raises this question of how important is execution at this point? Again, can we really extrapolate into a macro statement about the weakening consumer? Or is it that, oh, yeah, we saw that from Macy's with Blue Mercury and the fact that they were going to the higher income consumer with Walmart. They were catering to people who are trading down. They're just different types of execution that some of these are pulling.
There is a bifurcation when it comes to consumer and their ability to spend. I go to Mohamed El-Arian's opinion piece this morning. He's talking about the fact what Fed officials are saying. And he says the concern that he thinks the Fed has on data dependence comes with the risks. And one of them is how companies are expressing concern about weakening consumer demand. Mohamed called it when he said those in the transitory camp weren't listening to the CEOs on the earnings calls saying that inflation was still in the pipeline. Well, are Fed officials listening to corporates that are saying there is concern when it comes to the health of the U.S. consumer?
Well, the message is coming through loud and clear from the retailers, that's for sure. Target is down by 6% in early trading. The numbers were in line, but the outlook is pretty unconvincing, as we've seen from a few retailers so far this earnings season. Elsewhere under surveillance this morning, some top stories for you. Fed Governor Christopher Waller saying softening data in the next 3 to 5 months could allow the Fed to cut by the end of the year. Fed Presidents Mester and Collins also urging patience and more data in comments yesterday. Minutes from the May FOMC meeting are due at 2 p.m. Eastern Time. And Lisa, I've got no idea what additional information we could get from minutes this afternoon after we've heard from what? All of them? repeatedly in the last week or so?
Well, if you don't get anything, you can ask them later today or tomorrow or on Friday, because there's plenty more Fed speak. The one thing, though, that people are not talking about as much was actually Raphael Bostic in one of his 15 speeches over the past couple of days. He talked about how everyone is rethinking the dynamic of where neutral is. We heard that from Paul Krugman as well, basically coming out and saying that he is fanatically uncertain about where that neutral rate is. This, to me, raises the question, how can they have any conviction whatsoever when coming up with projections? If they're talking dots, these dots are highly confused and really speaking with invisible ink.
In fairness to Bostic, he was overseeing his own conference this week. We'll allow him 5 speeches, right?
And
he did have his own conference.
We welcome every single one of them. It was actually interesting.
It always is. Elsewhere, China sending signals it may retaliate in trade tensions over EVs. The China Chamber of Commerce to the EU saying the country could raise levies on imported large engine vehicles to 25%. Europe is also set to announce the results of a probe into Chinese EV subsidies next month. The timing is not a coincidence. Of course it's not. This is a potential threat against what might happen if the Europeans go through with what people think they're going to go through with.
Absolutely. This comes as they're trying to fend off what the EU potentially was going to follow through with in this probe when it comes to not just EVs, but a number of goods that they see that are being dumped on the European market from China. What I love about this is that China is going to their Chamber of Commerce to the European Union, and this is the statement. China Chamber of Commerce to the EU was informed by, quote, insiders that China may consider increasing those tariffs. Well, the insiders are the officials at the CCP in Beijing.
Yeah, I think we can all see right through this this morning and where this one's heading. I want to finish on this story. Disney announcing job cuts at animation studio Pixar. About 14%, or 175 employees, will be let go as CEO Bob Iger looks to cut costs. Elsewhere, Comcast announcing its streaming bundle with Netflix, Apple, TV Plus and Peacock will start at $15. A bit of news for you in the media space. We can do all of that with Bloomberg's Geetha Ranganathan. Geetha, let's start first of all with Pixar. What is the strategy here and why Pixar?
Yeah, the strategy here is nothing new. It's all about the cost cuts, John. And what we're really moving to now in this new era of, the media streaming ecosystem is really less is more. And especially with Disney, they're kind of going back to a more normal cadence of content output. And really the mantra for Bob Iger has become, quality over quantity. You had that whole pandemic era when they were just rushing to put out all types of content on their streaming platforms that obviously did not serve them well. They did not test or think through all those ideas. And it not only led to a lot of content saturation, but it also cost them hugely because there were $4 billion in streaming losses in that year, $2.5 billion last year. And so they're really trying to rationalize their content output. That is a big thing. That is what is driving, these cost cuts at Pixar. Because if you think about why they hired a lot of people in Pixar in the first place, it was to produce a lot of content for the Disney Plus streaming platform. And it looks like they're walking that back and just focusing now on the feature films.
Geetha, can you give us a little bit more colour on that? When you say getting back to a normal cadence, can you give us some numbers around that? What was the traditional cadence? What did it become? And what's it going to be in the future? Because the slate for movie releases this year at least is pretty dry, set to pick up next year. What can we expect?
So in terms of Disney's content budget, and this includes everything, this includes, their TV, their studio, their streaming business, during the pandemic, and this was when they were really producing a lot of content, especially on the streaming platform, it was close to almost 33 billion. That came down a little bit last year to about 30 billion, but this year it's down substantially. It's going to be about 25 billion. And going forward, that's really what they're looking at. They're really looking to kind of, come down in terms of producing the number of content titles, but really making sure that it resonates with audiences, and really this whole focus again on quality versus quantity. And you're absolutely right in terms of the output, the theatrical output this year is obviously a little bit light. That's due to the Hollywood strikes last year. But we are going to get back to kind of that more normal cadence going forward in 2025. And we're going to see that on the Pixar front as well. We have the big Inside Out coming out, Inside Out 2, which is coming out in June. And then, of course, we have, a Toy Story 2 and, Alio that's also going to be coming out in the next couple of years' time.
Geetha, I think that Annmarie and myself had a similar reaction, which is that Pixar is the jewel, the little hopping lamp and all of those things that people love. Is this basically peak content? We've been past that for a couple of years now, and essentially there just is too much out there, and there is a recognition of that from every streaming service, that they need to consolidate, they need to produce less, and they need to have a more streamlined way of delivering it to consumers.
It absolutely is, Lisa. I mean, there is this recognition across, even Netflix, which has pretty much won the streaming wars, is now kind of talking about, really kind of walking things back when it comes to putting out content. So if you just take the instance of Netflix, they were having, just about 2 or 3 years ago, they were having about 80 new films that they were producing and throwing on their platform. That is down to about 20 to 25 this year. So that there is this huge, content rationalization across the space. And in terms of Pixar, I mean, they got burned pretty badly, especially during the COVID era, because they had 3 of their movies kind of go direct to the streaming platform, if you remember. So there was Luca, there was Soul, there was Turning Red. And that kind of, I think, hurt the studio pretty bad. So when they did come out with their, theatrical releases, Lightyear, and then, of course, Elemental last year, those really didn't perform as well as people had hoped. And I think that's why you're kind of seeing this walk back of the strategy, especially on the streaming side. And people, the studio executives are really going back to what they know best, which is putting films in theaters, because that is how you really make money.
Geetha, will they deliver on their promise to break even when it comes to streaming by September of this year?
They're already there, Annmarie. So if the quarter that they just reported, they actually had a modest profit. And if we kind of look at, obviously in the fiscal third quarter, they said that they are going to have some losses. But if you look at it in the context of the entire year, we're probably going to see them near break even. And that's a huge improvement. I mean, just 2 years ago, it was almost close to $4 billion in losses. Last year, it was $2.5 billion. So this is huge in terms of getting to that streaming profitability number. And hopefully they will drive that going forward.
Geetha, great to catch up with you as always. It's good to see you. Geetha Ranganathan there of Bloomberg. I want to turn back to the Target story. That name is down by close to 8% in the pre-market. If you're just joining us, welcome to the programme. If you don't beat this earnings season, you get punished. And this is another example of that this morning. The numbers for the first quarter came in largely in line. Yes, they're still fighting to get back to growth. And yes, it was a down quarter on comp sales, down by 3.7% against an estimate of 3.68% negative. But the outlook just totally unconvincing. Second quarter adjusted EPS 195 to 235. The estimate was 219. And Lisa, the outlook for second quarter comp sales, an increase of 0 to 2%. It's the fight to get back to growth, and it's a struggle right now.
And it comes as they were facing a lot of protests over a number of their sales items. LBGT Plus, they had a number of different people who are boycotting some of their offerings. There is a question, this goes to Starbucks as well, how much the political component has challenged a recovery in a time where consumers are being discretionary. If you do talk about this on a global scale, it might not be that massive, but it might move the dial at a time where consumers are facing a number of different headwinds.
Idiosyncratic? I think you're going there, and it's the right question to ask. Whenever I mention that quote from Starbucks about discerning consumers, there's an absence of a conversation about more broadly about basically a boycott of Starbucks because of developments in the Middle East. And I think it's worthy of having a conversation. Is this really about the broader consumer for certain names, for individual names, like what happened with Target 12 months ago, like what's happening with Starbucks right now, and how much of it is just about execution and the I word, for instance?
Well, an idiosyncratic can be broadened out to the people who are in the strongest position are going to win most. And the people who have any weakness are going to lose most, because this is a time of exacerbating differentials. I think that's one of the messages we keep hearing.
That stock is getting hammered. We're down by 7 to 8% in the pre-market. We've seen moves like this after earnings season with Target. They get whipped around, pushed around sometimes, and they're getting pushed around right now. Danny Berger's got an update of that story and a whole lot more for you. Let's get to the Bloomberg Brief with Danny. Hey, Danny.
Hey, John. Donald Trump's defense team will not be calling the former president to the stand in his hush money trial. Instead, they've wrapped the case and closing arguments start next week. Now, meanwhile, lawyers in the classified documents case are due in court today. It's the first time since the judge indefinitely postponed the trial earlier this month. The judge is scheduled to hear arguments on a Trump request to dismiss the indictment on grounds that it fails to clearly articulate a crime. Now, along with Target, we got another retailer reporting results. Urban Outfitters, a very different fate, rising 5.5% in the pre-market trade. It posted first quarter sales that beat estimates. Its Anthropologie and Free People brands are what drove the momentum. Both chains posted higher than expected sales that helped offset some of the weakness at its namesake Urban Outfitters brand, where sales declined 12%. Boeing and NASA have delayed the launch of the Starliner space taxi yet again. Now, this time it's the two reviewing a helium leak that are plaguing the vehicle. The launch set for May 25th has now been put on hold. It's just another delay and another setback, of which there have been many. Costs have overrun on the project. There have been technical glitches and botched test flights as far back as 2019. And that's your Bloomberg Brief. John.
Danny, appreciate the update. Thank you. We'll catch up with Danny again in about 30 minutes' time. Up next on the programme, the path to a July cut.
In the absence of significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting and easing in the stance of monetary policy.
So Governor Waller freezing that path to a July cut. We'll talk to a man who thinks we can get one. It's Andrew Hollenhorst of Citi. Up next. Equity futures on the S&P 500 negative here by 0.2% in the bond market. Here's the shape of things. Yields higher by 3 basis points on a 10-year, 4.44. Under surveillance this morning, the path to a July cut.
In the absence of significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting and easing in the stance of monetary policy. The latest CPI data was a reassuring signal that inflation is not accelerating. And data on spending and the labor market suggests to me that monetary policy is at an appropriate setting to put downward pressure on inflation.
Here's the latest this morning. Several Fed speakers echoing the higher for longer narrative ahead of minutes from the Fed's May decision. Fed President Bostic adding officials are rethinking views on the neutral rate. Andrew Hollenhorst of Citi has this to say. Ultimately, it is upcoming inflation and jobs data that will determine the path of policy rates. We continue to expect a first 25 basis point rate cut in, drumroll, July. Andrew, sir, good morning to you.
Good morning.
What needs to happen between now and the end of July to make this happen?
Well, like I was saying in the piece, it really comes down to the data. We can spend all of our time listening to the Fed speak, and that's important, and it gives us some guidance about where they want to go. But where they will go will depend on the data. And so what we think we're going to see is softer inflation and softer activity in labor markets. And that's so important. And I think probably getting less attention because we've been so focused on the inflation data. If you put both of those together, that's going to be a pretty powerful sign to the Fed that it's time to start cutting rates.
Governor Waller gave the last inflation print a C+. C+. That's not a great grade. I know this is a ridiculous conversation. If you're just joining us, this is the state of business TV these days. This is what it looks like. Forgive us. C+ for inflation last month. What needs to happen then in the next print and the print after that? Because they need to be Bs, don't they, to cut interest rates?
I think so. If we're going to run with this analogy,
Please
I think
do.
so.
Governor Waller started it.
It was interesting because he gave the C+ to the April report, but then he said, I'm not going to tell you what GPA I need over the next few months. I'm with you, John. I think a B is probably where he wants to be. It doesn't have to be an A, right? But you don't want to be a C. And we're coming in this core PCE reading about 25 basis points. If we get core inflation readings around 20 basis points, then that's probably the B, and that's probably enough. So several months of 20 basis points core PCE inflation, I think that's where we're going to be.
Are certain economic data points more heavily weighted in the overall grade that they get at the end of the year? Is it, for example, you can get a C+ on the inflation rate on the CPI print, but if you get an A on the unemployment report, then all of a sudden ready to go?
Yeah, and that's where we've been, right? It's been an A, maybe even an A+, you would say, on the labor market for a long time now.
What are we talking about anymore? Is it A+ meaning it's good or A+ meaning it's bad? It's time to cut?
Meaning it's good, meaning it's good.
Carry on.
And the good data that you've had on employment, that's why we have so many Fed speakers talking about higher for longer and patience and the idea that there's the luxury of not being in a rush and not having urgency. That will really change if we start to see more weakness in the labor market.
So I know that you have one ear open to Fed speak, and then you have the entire focus otherwise on the data. However, Governor Waller's comments, especially in tandem with the whole host of other Fed speakers that we've heard, kind of has to put a little bit of a damper on the July rate cut. How much higher is the bar right now to achieve what you're predicting?
I think what we heard from Waller is that his base case is to cut rates around the end of this year, maybe next year. And the kind of importantly dovish thing that he said is he's certainly not thinking about hiking rates. He's definitely headed to a cut. And then once he starts cutting, he's going to be cutting at least every quarter, is what he told us. The bar for him to move that rate cut earlier, I think, is not that high. So if you read the full quote, he said, I need to have this better GPA on the inflation data or see some weakening in the labor market. If I see some significant weakening in the labor market, then I'll be moving earlier. So I really don't think that the bar is that high for him to move that guidance. And it's vague guidance also. Several months. Why are we saying several and not defining the term? Because that gives you flexibility.
But several months doesn't bring us to July. Don't you think you have to push back your cut?
Yeah, his base case is that he's going to be cut. It sounded more like November, December is probably his base case. And that's where it comes down to the data, right? If all of the labor market data just come in great and inflation is just kind of nicely but gradually slowing, then I think Waller would be supporting November, December. I think the core of the committee might be a little bit earlier than that. If you listen to Vice Chair Jefferson, if you listen to Chair Powell, it does sound like they're a little bit more dovish. Again, I keep saying the same thing. It will come down to the data.
Well, which data? A key feature of your research over the last few months has actually been on the labour market. And I think it's really important we develop that idea a little bit more. You're looking for weakness. Are we seeing cracks in retail? We've got Target down by a little more than 8% in the pre-market this morning. Lisa and I have been talking about the warning after warning we've had from various retailers over the last month. Where do you see convincing information from corporations, from C-suite executives, from the economic data that tells you we're going to see that pronounced weakening of the labour market in the next several months?
What we're always looking for is some mutual confirmation between what we're hearing from corporates, what we're seeing in the macro data, maybe what we're seeing in some of the survey data. And I think we're getting that now, and I think you're pointing to it, which is we've been waiting for when will high prices lead to consumers pulling back? When will that actually be a problem for consumer confidence and consumer spending? And it's just taken a very long time because there was excess savings, there was an ability to go out and spend, and it looks like we finally hit the point where consumers are maybe not dropping off a cliff in terms of their spending behavior, but at least saying on that additional latte that I might be buying or not buying, maybe I'm not going to buy it because the price has gone up a lot and I'm a little bit more worried about my job. And then that's where we look to the labor market data. And you do see in the survey data, people are more worried about losing a job. The unemployment rate is still low, but the unemployment rate has come up from its low. And it's a rising unemployment rate in an environment where the hiring rate has come down. So it's becoming harder to get hired into a job. Again, the excess savings has run out. We see credit card delinquencies that are rising. So all of these things kind of mutually corroborate each other and tell us that this is a slowing economy.
Andrew, we've been talking a lot about how confusing this economic cycle has been just because there's so many different economic cycles in the different industries that have kind of been overlaid on top of each other. Which sectors are going to drive the layoffs? Because we've seen already depressions and recessions in the industrial sector and then coming back. We've seen already the incredible layoffs in the travel sector, and then they had to hire massively. Who's going to be laying off everybody?
It's a tale of two economies. I think it's two economies for the consumer. If you're a renter, if you are not a homeowner who's experienced a big rise in the house price, you're pulling back on your consumption. And then it's a tale of two economies in the corporate sector as well. If you're a large corporate and you've taken advantage of low interest rates to borrow for a long period of time, you have healthy profit margins, then maybe you're not laying people off. But if you're a small business, if you're a restaurant and you're experiencing higher interest costs, higher input costs, higher labor costs, that's where the pain is really being felt. And that's, I think, part of what's difficult in the aggregate data, because the aggregate data just tells us the aggregate. Up until this point, that upper end of the income spectrum, that upper end of firms, large firms, has been supporting the economy. It looks like we're getting to a point now where these smaller businesses are feeling the pain, and that's where we're going to see the weakness.
3-month payrolls average is north of 200K. What do you think that rolling 3-month average needs to come down to? Can we put some numbers on it?
I think if we get sub 150K.
Sub 150.
And we were at 175K in the last report, so I think that's where we're going. I think that would be a sign to Fed officials that we really are in this softening labor market environment.
Interesting. Andrew, thank you.
Thank you.
Thoughtful stuff as always, buddy. Thank you very much. Andrew Hollenhorst of Citi. Not the first time he's gone against consensus. Remember when the hiking cycle started?
I do.
Was calling a big series of jumbo rate hikes. I remember the feedback I got when I put out that research and people were like, yeah, okay, sure. That's exactly what we got.
And Andrew was also ahead of the curve when he was saying stop expecting 6 or 7 rate cuts. It seemed like he was more hawkish at that point versus the market expectations. He's been right more than not.
The road to July. We'd have to see some real weakness. Let's see if we get it. Coming up in the second hour of Bloomberg Surveillance, we'll catch up with Drew Matus of Metlife, Henrietta Treyz of Veda Partners, former World Bank President David Malpass, and Tarlowe of Jefferies on the latest from Target, with Target in the pre-market having a tough morning so far. We're down, and we're down hard from New York City. This is Bloomberg.
The Fed is putting pressure on the economy, more pressure than frankly is needed to get inflation down.
I think the Fed wants alacrity of a decision one way or the other so they can get off the pot.
We've learned collectively how interest rate insensitive the U.S. economy in particular has become.
I would say the rates policy is definitely restricted.
I do think that they are restrictive, but I think it will flow through to the economy over time, and they can take out some insurance rate cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now. It is a massive day for earnings. A little bit later on, Nvidia, after the closing bout. That name is $2 trillion market cap, and it's up more than 90% year to date. It's absolutely ridiculous. The gains continue, and the analysts are expecting another beat and raise. Another beat and raise. This morning, we start with Target. Target in the pre-market is down by more than 8%. Retailers, Browne, in choppy waters.
Especially because it's not the same story for all of them. The rhetoric sounds the same, the actual results, and certainly the reaction that we're seeing in the equity market different. Walmart came out, talked about a cautious consumer, and then those shares ended the day up more than 1% because they were talking about some of the gains that they're having, particularly in some of their online offerings and with higher end people. Target, a different story.
What Target executives are saying is that consumers are searching for value. Discretionary spending is under pressure. You're seeing a more judicious consumer based on all the reports we're seeing. Now, Lisa, you brought up a good point. Is this idiosyncratic to certain companies? Potentially politics are involved. But when it comes to Walmart, higher end trading down, Target, people are looking for more value, more options. Starbucks, maybe they're forgoing the extra latte. There is some cracks that are starting to evolve, and we're seeing it in the earnings data.
Retailers are losing pricing power. Bottom line, that's the story. Andrew Hollenhorst of Citi was with us about 5-10 minutes ago, and he believes this is the beginning of the consumer slowdown. So if the retailer's losing pricing power and they want to maintain margins, what do? They need to cut costs. And when they cut costs, what might they have to do? They might have to lay people off. So the likes of Andrew, and he's alone at the moment. It's lonely. He thinks we get a rate cut in July because he thinks over the next couple of months, you start to see the 3-month average of payrolls growth decelerate to sub 150, and that lays the groundwork for this Fed to move. Now, that goes against the grain of the moment. A lot of people are in the high for longer camp, September, maybe even much later this year. But that's his call for the next couple of months.
I love the critical Fed speak analysis because that seems to be what everyone's doing. He said a few. A few could mean many different things. A few months could be 1, could be 2. Here's a question that I have. What does it take to get the unemployment rate a lot higher? Do we see smaller businesses that have already been acknowledged as being really in a weaker position, particularly at the Russell 2000, starting to already cut around the margins? He talked about restaurants, how they're struggling. To me, that might be the story more than some of the large cap names that have been managing this in a much more resilient way.
More Fed speak a little bit later. FOMC minutes this afternoon. For those of you that maybe are confused about where the Fed stands, look out for more clarity.
Oh, yeah.
2 p.m. Eastern time.
Yeah.
Something like that this afternoon. Equities right now on the S&P 500, the scores look like this. Equity futures negative by 0.1%. Yields are higher by 3 basis points on a 10-year, 4.4433. Yields up across Europe as well. An inflation surprise in the UK, an upside surprise, meaning a slightly stronger pound sterling against the US dollar. We'll touch on that story a little bit later. Coming up this hour, we'll catch up with Metlife's Drew Matus with stocks at all-time highs ahead of Nvidia earnings. Former president of the World Bank, David Malpass, on the debt issue facing the United States, and Tarlowe of Jefferies reacting to Target earnings, with Target down in the pre-market by something like 8%. We begin with our top story. Stocks hitting all-time highs ahead of the earnings report we've all been waiting for. Nvidia, the poster child of AI, soaring year to date and once again facing sky-high expectations. Analysts projecting a revenue jump of 243% in the first quarter. Drew Matus of Metlife is with us around the table. Drew, good morning to you.
Good morning.
My favourite question, I ask it all the time. Jensen or Jay, who's more important to this market?
Neither of them.
Why?
I don't think they know what they're going to do. We're actually, Andrew's not alone, so we're in Andrew's camp with a July rate cut. What's going to cause it? It's going to be the weakening of the labor market, which Waller hinted at. And I think, you've already seen it. Last month, everyone's focused on the 175. 88% of workers saw a decline in real wages in the month of April. Right. So you take how many hours are being given, even though their average hourly earnings are going up, the number of hours they're getting to work is going down in many cases. And when you net that out with inflation, 88% of people are falling behind. That helps to explain why people are responding in the way that they are, right? Like, how do I cut back? How do I reduce spending in certain areas? And it's because, you know what, you buy a cup of coffee and you're in shock. So it's not just, rate shock for mortgages anymore. It's latte shock.
I'll ask you the question I asked Andrew. 3-month payroll average right now, north of 200K. Where's that going to be later this summer?
I think it'll be below the 150 that Andrew was talking about. But more importantly, I think the unemployment rate will be higher. And the politics at the Fed will change as the unemployment breaches 4%.
How come this doesn't seem to be coming through in the earnings that have been actually ratcheting higher in terms of expectations? A lot of the commentary from retailers, yes, it hasn't been that positive, but there was something like an incredible high short selling quotient of retail sales, retail companies. It's not like this is unexpected. So where do you expect the unexpected to really materialize?
Well, it has been somewhat unexpected, right? People went from there's going to be a hard landing, which that was us, and then we threw in the towel on that. And then they went to there's going to be a completely soft landing, most people. We kind of went somewhere in between, which is where Andrew ended up as well. I think, what you're seeing in the equity market is planning for the future, right? What's the next 3 to 5 years look like, right? Where are the productivity enhancers in the economy? Where's the spending going to go in the economy? And the reality of it is, you still have to keep planning for a future that's going to be driven by certain technologies. You don't necessarily have to plan on, where the consumer is going to be shopping.
Okay. Where does this leave you in terms of where you think the market's getting it wrong? A lot of people saying that the stock market's shown resilience regardless. It's not necessarily the economy. It's continued to chug along because of the Nvidias of the world. And at the same time, these rate cuts are not going to lead to a 2% type of Fed funds rate. You're not going to see the same types of neutral rates that we saw pre-pandemic. Where do you sit on this? How are you sort of pushing against the grain right now with the most contrarian call you have?
I think what you're seeing really is if you're going to take risk, you might as well have some upside, right? And so everyone's kind of leaning towards the equity space, right? Because, spreads are tight. In terms of credit, you just want to get your money back there, right? So it's a matter of kind of, do I get paid for the risk I'm taking? In a lot of cases, the answer is no. And then people are shifting towards the areas where the answer is yes. We are not heading back towards the zero rate environment. I think globally, some of the best things that have occurred are Japan moving off the zero rate bound, right? That's a huge thing. Zero rates are just horrifically bad ideas. And I think people have finally come around to that view. But I do think, the longer we're off zero, the better from a Bank of Japan perspective. The rest of the world moving and cutting very gradually is okay. The real trick will be, can the Fed manage to kind of cut rates just enough to kind of keep us from going into a deep recession or a downturn? I think the risk right now is that they either hold out and cut too much too quickly and kind of overstimulate things and then have to kind of reverse course, which they're trying to avoid, or they don't cut enough, right? So they do have to thread this needle in order to kind of keep everything on an even keel and avoid seeing an unemployment rate with a 5 handle or higher.
You mentioned Japan. Let's sit on that for a moment. 10-year JGB, 1%. This was not the disruptive journey we thought it would be. We thought when we started to get the repricing of the JGB market, you'd see some real problems in fixed income. Why have things been much calmer, not just in Japan, but in Europe as well? Why has Europe been able to pull back from QE and we haven't had that peripheral debt explosion we all worried about? What's going on here?
So the QE is a really technical one. If you want to do like a 2-hour special on that, I'll come and I'll give you the whole
minutes.
Thing. Okay. So let's just do 10-year yields.
Sure.
The vast majority of people who are saving for the long term are saving for retirement. If you have a zero rate on your 10-year yield, people have to save more for retirement, not less. So you actually reduce the rate of growth in your economy. You actually then boost it by allowing yields to move higher, right? I know Rick Reeder was kind of hinting at stuff like this before.
Yeah, Rick's going there.
It's not surprising. We both worked at the same place a long time ago. If rates are at the levels they're at in the United States right now, kind of the 4.5 range, that is the optimal level for reducing the rate of savings in the economy and stimulating economic activity. So the Fed's response function actually might be more of a feature of where the 10-year yield is around this barrier. So if it drops below 4, there's a problem. If it goes above 5, there's a problem.
Can I ask you what you think the new equilibrium is with that in mind? What do you think we're sort of settling into? And I don't want to call it the new normal because you might call it the old normal. Yeah. What do you think it is? What is this normal now?
I think it's kind of 4.5-ish on 10s, and let's call it 3%, 3.5 on funds. It really depends on what happens to productivity going forward. We're actually very bullish on productivity going forward because of artificial intelligence and kind of the related areas around that, what that can do for people, and what it can do actually for the training of the labor force, which we think is the material area it'll have the impact on.
Aside from Fed meeting minutes, we also get existing home sales today, and we get a slew of home housing data this week. There is a school of thought that if the Fed cuts rates, that's actually going to cause housing prices to fall.
Yes.
Do you agree with that?
Yes.
Okay. So how does this sort of play out, given that a lot of people think of high rates as restrictive and lowering prices, that if you lower rates, you actually end up triggering a sell-off in certain asset classes?
So how does that play out? I mean, I think it's going to play out on the upper end consumer that's paid off their mortgage, that might be more invested in stocks, begins to see that their overall net wealth isn't increasing the way they thought it would. And so they begin to cut back on spending, or they begin to pay more attention to prices. All right. So, as wealth declines, people pay more attention to their outflows, and the outflows are accelerating. I mean, go to a grocery store and when was the last time you put anything back before 2 years ago? Like you picked up something off the shelf, looked at the price and said, you know what?
Berries.
Kids can live without.
I can't deal with berries when they're over a certain level.
You have a level in mind?
100%.
What's your level?
$6.
$6 on what?
Blackberries, raspberries, blueberries, absolutely a no-go. But when they're $8, absolutely not.
$8 is Brammo's limit. Drew, you got that?
I'll try to bring it at $7.99.
Okay. Drew Matus and Metlife, responsible for the price of berries in the New York City area. Drew, thank you, sir.
Thank you.
Appreciate it. Let's talk about Target. The name is down by 7 or 8% at the pre-market. Let's get you an update with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. So, yes, the shares are lower pre-market. The midpoint of the company's outlook fell short of estimates. The company said that they remain, quote, cautious on their near-term growth outlook and do expect discretionary spending to remain under pressure. As you've been talking about, Target announced that they would cut prices of about 5,000 items at their stores. Now, Tesla is losing ground in Europe. The EV maker sold under 14,000 cars in the month of April. That's down 2.3% from a year ago, and it's also its worst month since last January. Tesla was the exception, though, in Europe. EV sales overall rose 14% in the month. Tesla had also reported a downturn in shipments from its Shanghai factory for the month, which also contrasted with strong growth for China's broader plug-in car industries. Now, Oaktree Capital has taken ownership of Italian football giant Inter Milan, not because they bought the team, but instead because the club's owner defaulted on a loan provided by Oaktree. Now, it is somewhat rare for a lender to take the keys instead of extending a new loan, given that lenders are rarely in the business of ownership, especially when it comes to a complicated asset like a football club. Now, Inter had been in talks with PIMCO to refinance its debts, but couldn't get a deal done before Oaktree's deadline. The timing is notable. Inter Milan had just won their 20th Serie A championship last month. And that's your Bloomberg Brief, John.
Danny, thank you. As an AC Milan fan, I would laugh, except almost the exact same thing happened to my club a few years ago. Elliott Management. What is it about Milan clubs right now getting taken over by asset managers because they can't pay their loans?
All I can say is, can you imagine the face and the reaction to the person over at Oaktree who's suddenly responsible for Inter Milan?
Same thing at Elliott Management. It's
my God.
We own football clubs now.
Exactly. How are they going to manage that?
Good news, though. When Elliott Manager took over us, we went on to win the league.
There you go.
Great turnaround story. Fantastic. And we hope the same thing doesn't happen over at Inter. As AC Milan fans, we wish Oaktree the best, of course. Up next on the programme, closing the gap in swing states.
The fundamentals of this election are still staying true, and we're seeing this in polling. It comes down to the issues of inflation and immigration crime. We're 166 days away from the election. We know it's going to tighten.
A conversation just around the corner, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures softer here by 0.1% after closing at record highs in yesterday's session. Yields are higher by 3 basis points on a 10-year, 444.53. Under surveillance this morning, closing the gap in swing states.
The fundamentals of this election are still staying true, and we're seeing this in polling. It comes down to the issues of inflation and immigration, crime, and then on the other side, abortion and sort of that democracy chaos sort of issue on the Democratic side. We're 166 days away from the election. We know it's going to tighten, and it's going to tighten further once folks really start focusing.
Here's the latest. President Biden closing the gap with Donald Trump, making gains with swing state voters in the month of May, according to the latest Bloomberg Morning Consult poll. The poll also showing more than half of swing state voters are worried about violence following the election. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, this is the argument that we hear a lot, and we heard it earlier this morning, and good morning, by the way, that the closer we get to the election, the more focus that voters will have. And the base case for a lot of people is that those voters, once they become more engaged, will lean towards President Biden. Why is that the base case, Henrietta, of so many people?
Great question, and thanks for having me this morning. Yeah, that's what your polling data is telling us. The disproportionate number of undecided voters in your polls and many others are independent voters, female voters, minority voters, and dual haters. And that basket of voters was Biden's demographic in 2020. And so what I think is really interesting when you look at the data right now versus 2020 turnout, Trump is not ahead of where he was in 2020. Indeed, in a state like Wisconsin, for example, I was just looking at your crosstabs, he's underwater by 10 points with seniors 65 and up in those swing states. The same is true in Arizona, where he's down by about 7. So the delta between Biden and Trump is not because Trump has a higher amount of support now than he used to. It's because Biden's support level is withholding. Those withholding voters are going to either RFK Jr., they're still undecided, and about 3% are going to Jill Stein and Cornel West. So the natural tendency of that basket, should they get off the fence, most likely after Labor Day or maybe after an event like the debates next month, are going to be an inclination towards Biden. They're not a natural resting place for a Trump voter. And so that's the sort of basket of undecideds right now.
Henrietta, your research also talks about this demographic shift. Biden winning the older crowd, while Trump is actually bringing in some of the youth. What is responsible for this?
Right. Well, it's really fundamental stuff, a little bit morbid, but the 65 and older demographic is very different than it was 10 years ago, last time Trump was elected. So the supporters who went for him in 2016 are really just no longer with us. And so that is no longer the greatest generation. This is sort of the Woodstock generation. And those are, some hippie Democrats who are disproportionately coming out in favor of Biden. And the delta, as I mentioned, in Wisconsin is 7 points in your poll, in Arizona, 10 points in Wisconsin. And the last poll was 17 points. So these are high propensity, constant turnout voters. They represent a 30% basket of the overall demographic that turns out to vote. And what's interesting is that a lot of Trump's gains, he swapped those reliable voters for wildly unreliable voters. That is, your 29 and under cohort. If you look specifically at young Black voters, the delta between 65 and up demographic and the 29 and under is something like a 300% more likely voter for Trump in the youth demographic. And first of all, I think those are probably pretty unreliable numbers themselves, but then the most defining characteristic of those specific cohorts is that they don't vote. So he has swapped support in the polls for a demographic that doesn't traditionally turn out. They're about 5% of the vote, for a group that is very reliably voting. And now it just so happens, based off of time having gone by, that these are a cohort of voters that are more Democratic than Republican.
Henrietta, Biden cannot win without holding on to the blue wall. Yes, I'm looking at our data. He performs best in the blue wall states, but he's still behind. Wisconsin, Trump is still beating him. Michigan is the only place he's winning. Pennsylvania, 46% Biden, 48% Trump. What does he need to do in these 3 states that are critical to winning the White House?
Well, I think you see the administration deciding the trade is the direction to go here. Ambassador Tai wrapped up her very aggressive 2-year review of the Section 301 tariffs. So we got a 3 times higher tariff on steel, tariffs on electric vehicles, tariffs on the components that go into electric vehicles, more export controls on semiconductor equipment. And then, of course, you have the influx of manufacturing subsidy going to all of those Rust Belt states, as well as a whole bunch of the red states. Indeed, something like 53% of all the job creation and revenue from things like the Inflation Reduction Act, which is all those clean energy and alternative batteries, clean batteries, those components are going to red states. So I think that the administration is pouring on the trade stuff pretty heavily. And then in Michigan, you have a pretty substantial block of the voter base, 200 to 300,000 voters who are uniquely in tune with the Gaza-Israel conflict and are really following that closely. So I think you see the administration paying attention to those issues specifically. And then on the youth voter side and really all age demographic side, you have a focus on reclassifying marijuana. And then I think, of course, the administration's going to focus on abortion as much as possible and pass a executive order strengthening the amnesty restrictions around immigration. So they're really using the bully pulpit that they have right now to go after every facet of voter issues. You mentioned the democracy piece. That used to be something that I think split Republicans and Democrats. They were both concerned about it pretty equally. Now it's showing a clear bias towards Democrats who are afraid and independents as well of, violence, the fact that, Trump might try to run for a 3rd term in office if he wins the 2nd one, the stuff about the, United Reich from yesterday. Those are all pieces that I think turn off your independent and Democratic voters. And in 2020, it motivated them to come out. So that's what I think the Biden team is trying for.
Well, Henrietta, that's where I wanted to go. How much is this going to be a motivating factor since this has been sort of a known factor for so long? We've seen President Biden try to lean into it. We've seen all the court cases that are ongoing with the former President Trump deciding not to testify at the latest trial. Does any of this matter? Or is it basically baked in and the people who care are going to care, the people who don't care are just going to maybe even use this as fodder to donate more to Trump?
Yeah, what's interesting to me is that you haven't seen data suggest that the court trial is moving anything until just about the last week. But your polling released last night or overnight, it shows very clearly that it's starting to become an issue. I think one of the things that I encourage investors to do and our clients is to say, what can we hold on to? What's actually tangible that we can see? And I say, look at Indiana last week. You have a candidate who is sort of the moderate wing of the Republican Party who has been out of the race for 2 whole months, and she just got 22% of the vote. That was in suburban, wealthy, affluent, married, white districts. Those are the groups that Trump lost in 2020 and is losing again to a candidate who's literally not even running. So I think the trial stuff is actually translating in real time, maybe not necessarily as quickly as it would for any other candidate. Obviously, we know that we've got a Teflon Don kind of situation, but it's starting to seep in for sure. And I think it plays into that narrative of this is an unreliable guy who you don't know what he would do when he was in the White House. I think that's something the Biden administration is trying to pick up on.
Can we finish on the double haters? And can we finish on the sitting president? Henrietta, traditionally, I think what we'd expect now is for Biden to move towards the center. For those of us that watched that speech, the commencement speech over the weekend, that was deeply divisive and certainly wasn't someone trying to hold the center. Is that going to be the approach in the months ahead? And how successful do you think that will be?
I think that speech was targeted specifically at the Black audience that I think the administration should rightly be very concerned about. The level of apathy that you see towards Biden right now from that demographic is something that they really need to work with. Winning Georgia or North Carolina or any state in the South, and I guess now the Sun Belt, is something that you really need to turn out both Latino and Black voters. And that speech was clearly targeted at the Black voter audience where they've hemorrhaged support. I mentioned that 300% decline between a Black voter who's under the age of 29 versus the 65 and up voter. That's something the Biden administration relied on heavily in 2020 to get elected, and they need to motivate those voters. One of the other things that I think plays into the conversation we had about the 65 and older demographic and how they're not the greatest generation anymore, they're the Woodstock generation, is voters in America are increasingly more Democratic oriented than they are Republican. So these voters have issues with climate change, with abortion, with gun control, things that do not naturally lend themselves to the traditional old evangelical Christian conservative Republican demographic. This is a Democratic base, and I think that's what the Biden team is trying to turn out.
We've got to leave it there. It's got to catch up. Henrietta Treyz there of Veda Partners from New York. Equity futures just about negative. This is Bloomberg. Two hours away from the opening bell, equity futures on the S&P 500 down here by about 0.1%. On the Nasdaq 100, totally unchanged after closing at another record high in yesterday's session. In the bond market, a 2-year, 10-year, 30-year is pushing a little bit higher on the yield side of things, up 3 basis points at the front end to 4.86. Just creeping higher again on a 10-year by 3 basis points to 4.4414, following an upside surprise on CPI in the UK of all places. So switch at the board and we'll finish on foreign exchange. The pound looks like this against the US dollar, just about stronger by 0.05% at 127.15. I don't think it changes the journey for the Bank of England. It might change the start point. It's not going to be June potentially in the minds of many in the City of London for that first rate cut, maybe later in the summer. But ultimately, Lisa, most people assume the next move out of the UK will be a cut.
It's messy, though, and data is messy. And the one thing that you've really picked up on, I think, done a wonderful job, is highlighting how the ECB sort of stands out in their conviction and their unwavering, almost commitment to June as a rate cut. It raises this question, okay, how important is it for some consistency in data versus we know where we're heading? Why not just sort of kick it off with a little, I don't know, cut here, cut there?
How many central bank chiefs do you hear say, I'm confident we've got inflation under control? And that's what we hear from Christine Lagarde. That's what we heard again this morning.
Well, and that's because she's facing off an economy, and frankly, it's a myriad of different economies, it's not just one, that are really facing some serious headwinds. We're not seeing that in the same kind of way in other places, and the UK doesn't have the luxury of catering more to that than just, the inflation. I'm sorry, we talk about the Liz Truss moment that isn't in the United States. They have that sort of threat still sort of hanging over the economy.
We'll talk about whether we could get one here in just a moment. I know that's your favourite conversation. Under surveillance this morning, your top story, a light day of Fed speak. Just Austin Goolsbee on deck, but we'll also get the Fed minutes at 2 p.m. following comments from Cleveland Fed President Loretta Mester saying she wants to see a few more months of inflation data coming down before cutting interest rates. Shares of Target lower in the pre-market. The company's outlook falling short of estimates. The retail giant saying they remain, quote, cautious on their near-term growth outlook and expect discretionary spending to remain under pressure. AMH, that stock is down 7% in early trading.
They're talking about the consumers are searching for value and they're spending more on services and out-of-home entertainment, and they remain cautious. We continuously hear this from the consumers, Jonathan. It's coming from less so, yes, we had a inline CPI that everyone's saying was a beat. But really, when you see what's happening with the consumer, it's coming in the earnings report.
So this is Target, and if you miss, you get punished. And as you said, a meet for some of these names is like a miss for a lot of people in this market because of how much stocks like these have run up. What's going to happen to Nvidia? If Nvidia later on misses estimates, we're counting down to those numbers after the closing bell. The stock's soaring more than 90% year to date, accounting for about a quarter of the S&P 500 return this year. The poster child of AI and the boom there, facing sky-high expectations. The street estimating a revenue jump of 243% in the latest quarter, Lisa. This stock has had quite a run.
Especially given the fact that some of the swings on earnings day have been something like 20% in a $2 trillion name. It just sort of gives you a sense of why this is so important. I would argue, actually, it's going to be more important to see the broader market response to what we get from NVIDIA. If we get the sense that corporate spending on artificial intelligence is falling off in any way, shape, or form, I'm not saying that we will, or even just not meeting expectations, what does that mean in terms of the sea change that everyone's betting on for productivity, for generating new business, et cetera, that a lot of people say is fueling the overall rally, not just NVIDIA?
A big earnings release a little bit later on this afternoon. Later on this morning, of course, Caroline Hyde, Ed Ludlow, picking up the mantle and driving the story forward on Bloomberg Technology. Elsewhere, let's turn to the bond market, sounding the alarm on U.S. debt.
We're running big structural deficits, and it's, we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later.
There has been an increase in the interest rate path that's assumed, and it's necessary to make sure that we're on a fiscally sustainable path.
The level of debt in the United States, the level of spending is something that we need a sharper focus on and more dialogue around than what we've seen.
Concern growing over the budget deficit, with the CBO warning US government debt is on the path to 116% of GDP by 2034, even higher than during World War II. David Malpass is the former president of the World Bank, and I'm pleased to say he joins us in New York. David, good to see you.
Very good to see you, John.
We caught up with Mike Wilson at Morgan Stanley just yesterday. Here's a quote from him. The risk in the story for the next 6 to 12 months is, do the markets start to balk at this unsustainable fiscal policy? How close do you think we are to that moment?
I think we're in a box, and there's not really a process to try to slow down the spending growth. But the market is receptive to any message that would make it look like you're going to make progress on it. So you can't say how close are we to the moment, because it really depends on what kind of communication is done over the next year.
And the outcome of some of these decisions we've got to make. You wrote in the Wall Street Journal, I know you spoke to Annmarie about this in the last couple of weeks. I want to quote the story again. All the things that are lining up for the next, let's say, the next president, if it is indeed the last one or the sitting one. The suspension of the debt limit expires January 1. This year's spending bills will likely be extended just long enough to kick the can into 25. Tax rates will rise at the end of 25 unless Congress and the president can agree to extend some of them. What are the outcome of those decisions going to be, do you think, and how consequential will they be for the story, the conversation we're having?
Each one is important of those three. So the debt limit has this hard stop that you default if you don't raise the debt limit. So it makes Congress do something, and also the president. I've been through lots of debt limit increases. At the end of it, the president comes down and says, we're doing this because we have to. I've advocated strongly that we rewrite the debt limit so that it's stronger. It can't have default at the end. It's got to have measures that penalize Washington when they're over the debt limit that they're trying to achieve. On spending, it's problematic, and on taxes, it's going to be a very complicated process to try to stop the harm from the tax increases that are planned. They're automatic as the Trump tax cuts expire, and then President Biden has said he will add more to those already large planned tax increases. So you really need a break from that, or the market will start pricing it in.
David, the cost of extending those tax cuts, though, is about $5 trillion. How do you square that with your concern for the deficit?
I challenge whether you can say the $5 trillion. That's economists saying we know what the future is, and we saw how well that worked out on the inflation.
This is
0%. Yeah, well, so CBO's forecasts haven't been closer than the Fed's, haven't been closer than really the blue chip. The idea that the inflation, that you could have 0% interest rates and not do anything about it, and then it wouldn't, and they were saying it wouldn't cause asset bubbles. But now we're in a box. The markets are in a box. The fiscal policy is in their own box. And then the Fed itself, you just mentioned all the various central banks are all trying to figure out what they can do to bring down this inflation rate. So I have one thing, which is production. Each of the central banks has to realize they're not the ones now causing the inflation. It's the government spending and the lack of production going on in all sectors, especially in energy. But I think it's happening across the board. In the mining sector, the world needs more stuff, and the regulatory policies are impeding it. So the central banks should be pointing the finger back at that.
When it comes to spending cuts, though, you and I both know all the policy fights are in this discretionary spending. That is a very small piece of the budget. You could take it or leave it. It's not making a dent when it comes to our deficit. What is the plan for entitlements? Because we haven't seen the former president say he wants to really go in on entitlements. He kind of touched it once and then backed away. Unless this country decides on a plan for entitlements, there is no trajectory towards sustainable fiscal health.
I don't think you can start there because you've made commitments to the elderly. The transfers are going on. So the real question is, how do you reestablish checks and balances within the system so that the entire Washington network, that's the White House, the Congress, and also the lobbyists, everybody has to realize that they're going to feel pain if they keep spending the way they are. And then they politically will figure out which things to start with. But I don't think it's fair to say, let's start with the entitlements just because they're the biggest ones. You have to show that you can restrain growth in any kind of spending in order to give confidence to people that you're actually looking at the problem and dealing with it. We had heard all those quotes from famous people there prior saying, they have to do something about it, they have to do, but Washington's plan is not to do anything about it.
You said, I want to go back to this, I want to make sure I got this right, that if you let the reduced tax rate roll off, that will actually be a reality check for the market in terms of pushing back on some of the rate cuts. Isn't more tax cuts potentially, especially in tandem with more tariffs, going to be concerning for people in terms of the deficit and the U.S.'s position?
I think you can get a lot more growth out of the U.S. economy. They're trying to say the economy is doing well, but for lots of people in the bottom half, the affordability problem is giant. There's a lot of people not in the labor force because they don't see the path forward for them with skills and ways to get ahead. So I think there's lots that can be done that would allow more growth through better tax policy. So I don't think you can just go at it and say, well, if it's a tax cut, that's going to scare the bond market and be harmful. That's not the way it's worked in the past. There's every chance for the U.S. to say we are a growth economy through production, through good policies, and that will make the bond market more comfortable. Think about it. Where should interest rates and yields settle? I think lower than where we are right now, but the path, how do we get there? You have to show that you have enough supply chain within the economy that inflation is not going to keep being a problem.
Are tariffs a growth policy?
They can be if you're specific on where they are. What is your goal with the tariff policy? That's to have skills developed in the U.S. rather than being dependent on skills elsewhere. Some tariffs, and historically there have always been some range of tariffs and there's laws, I worked a lot on this, Section 201, 232, 301, and so Washington's been thinking about this issue. What is an effective way to interact with investment? Call it industrial policy in a way that helps the economy. And I'm not, so it's very important to think about it from what is your growth plan? And right now my concern and CBO's forecasts show there isn't any growth plan at all. Year after year, the U.S. is expected to grow slowly, and the bond market is going to get more and more worried about how do you pay all this debt.
I have to say that what you're saying right now is fairly radical compared to what a lot of people say. A lot of people say more tax cuts, which reduces revenue into the government, and higher tariffs could potentially cause, not necessarily a Liz Truss moment, but a real kind of reckoning in the bond market, especially as foreign investors shift away, especially if the U.S. policies are nationalistic. You completely reject that, and you actually think that that will entice more people into the U.S. bond market if the U.S. reduces taxes and increases tariffs selectively. Just how much pushback do you get when you put that out there?
Well, I think that's a core mainstream supply side approach that says that the economy should not be satisfied with 2% growth. This was a major issue in the 2016 election. The CBO was forecasting slow growth forever, and there was a difference in the dialogue on it. And so I think there has to, otherwise, what's your plan for paying $35 trillion of debt?
I got it right here.
You can't do it with slow growth. So I'm specifically saying you have to rewrite the debt limit so that it actually works. You can't threaten default at the end. You have to threaten other bad consequences that don't scare the bond market and that actually would make the bond market happy. And same on the Fed side. I really think the Fed has to be saying, we're not now causing inflation. We have the rates high. We've said what we're doing as on the balance sheet, and the rest of and then just stop talking. This is not the Fed's responsibility now. They have to answer for why did they have the rates so low and very slow on the hike side, but they've done a lot now, and you have to toss it back to the rest of the government.
Would you be interested in a seat at the central bank?
All I want is people to have a dialogue on good policies and actually talk about it in the way that we were just now. There's got to be some debate over, is 2% growth good enough for the economy?
Would you like to be part of that debate? Because you could be.
Sure.
Yeah? You'd be open to that. Have you had a conversation with the Trump campaign team?
Not at all. They're busy trying to handle in court and get any message and get the message out. But I am talking, I think we have to look at what the current plan is by the U.S. government, and that should be concerning to the bond market. The U.S. plan is to raise taxes a lot and keep spending like crazy. Now, that's not a very good plan, and that I think is what the risk is that's in the bond market.
I'm pleased you're with us because I think it's worth having this conversation. You saw that story in the Journal recently where there were some unnamed sources suggesting that the former president, would like to take more of a role in the decision-making taking place at the Federal Reserve. What was your reaction to that story? Have you heard anything around Camp Trump that suggests that's true?
No. And so my reaction to that was people are doing this to leaders all the time of saying, I think they're thinking this. And in the end, what matters is what do the leaders actually want to do? So if you say, what does candidate Trump or what does President Biden want to do, that really becomes a very important issue. And reporters kind of look around and say, well, we can get somebody to say that the plan is this. Let's write that down. So it's really going to come down to what do the leaders want, and do they see the importance of growth as a way to create jobs, good jobs across the economy?
Well, hopefully in the months to come, as you engage a little bit more in the election, we can catch up again and talk more about it. It's good to see you, sir. Thank you. Thank you very much. The former World Bank President, David Malpass there. Your equity market negative by 0.1% on the S&P 500 with an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. ECB President Christine Lagarde is yet again giving the green light for a June rate cut. She called it on Tuesday a, quote, strong likelihood. Lagarde said that she is confident that inflation is under control. What happens after June, though, is another story, with ECB Governing Council members refusing to commit to any certain rate path. Bundesbank President Joachim Nagel also said yesterday that even if they cut in June, quote, that doesn't mean we will cut rates further, and we are not on autopilot. Voters headed to the polls yesterday for a special election in California for former House Speaker Kevin McCarthy's seat. State Representative Vince Vaughn won the race with about 60% of the vote over fellow Republican Sheriff Mike Boudreaux. With that vacancy filled now, it brings Republicans' slim majority in the House to 218. And a cheap yen may be tempting for those who want to travel to Japan, but if you have a fear of flying, you might want to hold off. Data from Turbly Data, the database, shows that flights leaving from Tokyo have the most turbulence of any long-haul flights. For shorter flights, the trek from Santiago, Chile to Santa Cruz in Bolivia tops the list. The world's most unstable routes are in the spotlight after the deadly turbulence on a Singapore Airlines flight killed one man and critically injured 7 others before making an emergency landing in Bangkok. And that's your Bloomberg Brief, John.
Danny, thank you. That's pretty dark stuff. Did Lisa plant that story?
Hey, absolutely not. You know I have a fear of flying, and I absolutely don't look at those stories.
For that?
Absolutely not. And I've flown some of those routes.
Every time we do an airline story, I apologise. I always try and tell people to turn the volume down in case you're flying this morning. I'm sorry. Up next on the programme, the consumer under pressure.
We think the consumer is discerning right now, and we expect that trend to probably continue for most of the year. The consumer is looking for value and looking for lower prices.
That's up next from New York. This is Bloomberg. Equities on the S&P 500 negative here by 0.15%. A sneak at the bond market, sneak peek, yields up by 4 basis points on a 10-year, 4.4531. Under surveillance this morning, the consumer under pressure.
We think the consumer is discerning right now, and we expect that trend to probably continue for most of the year. What we're learning is the lower income customer is under the greatest amount of stress. The upper income customer, because of housing prices and where they are and the wealth effect of the equity markets being strong over the past couple of years, are more resilient. The consumer is looking for value and looking for lower prices.
Well, here's the latest. Shares of Target falling after the company's second quarter outlook fell short of estimates. The retail giant expecting discretionary spending to remain under pressure in the near term and announcing its plans to cut prices for around 5,000 frequently purchased items. Corey Tarlowe of Jefferies joins us now for more. Corey, good morning to you.
Good morning. Thank you.
What did you make of those numbers early this morning? Are they as bad as that stock price move suggests they are?
I think it was a bit of a knee-jerk reaction, to be quite honest with you. What I think we're seeing is a pullback, as we mentioned earlier, about on behalf of the consumer, and specifically in discretionary categories. The consumer shifting from needs or wants into needs. And we saw this in the Walmart print last week. And as we glean some insights from that, what did we see? Well, discretionary sales were pressured. What do we know? Well, discretionary is also a really big portion of sales for Target. It's actually much bigger for Target than it is for Walmart. So there are some sort of breadcrumbs that we've been able to pick up from other companies reporting over the last week or so. And it's all led to this point where we know consumers have been pressured, trading down into value, and pricing and value really do matter.
There's also this question of who wins, because ultimately, as you get sort of a shrinking pool of just endless spending, there are going to be winners and there are going to be losers. How much is this a story of execution and potentially of lost market share of Target that's consistently come in kind of on the back foot when it comes to Walmart?
I think the key is really that Target's had issues, right? They had inventory issues a few years ago. Now they have market share issues. They have comp sales declines. What we're looking for more going forward is a return to growth. The good news is we saw that in the second quarter guide, and we see that in the full year guide. But it will take some time. So the comp sales were down low single digits in the first quarter, as we saw in the print today. Second quarter, companies guiding for comps to be flat to up 2%. That's the same for the full year. That's going to be driven by a mix of likely traffic return to growth and ticket. Will we see that? I think so. Likely more indexes, I think, towards the midpoint of the guide versus maybe prior to the high end. But we'll see what they say on the call. And I do think that over time, you are seeing more and more shift into Walmart. And so this is going to be a narrative that's likely in existence for quite some time.
But you believe the cuts on a number of these items is a win-win for the consumer and for Target. Do you expect them to cut more items?
Well, what we do know is that inflation's been relatively sticky, and we actually had Walmart management in our offices not too long ago, and what they told us was that their private label segment, which is $100 billion of a $600 billion retailer, is actually running deflationary. And what did we see in the release earlier this week? Target's cutting prices on 5,000 items. 1,500 of those items have already seen price cuts. A significant portion of those items are also private label. So as you start to see more private label growth, it's a third of Target's business, about 20% of Walmart US business. You're going to see, I think, a little bit more focus on value and price, which is probably going to, we think, reaccelerate market share gains ahead.
Walmart talked about customers trading into Walmart and potentially away from names like the ones we're talking about right now. What can they do to make sure they keep them, to make sure this is not just a moment in time, that they actually stick around for years, not quarters?
Well, one of the things that Target did recently was they reinvigorated their loyalty program. And we saw the Target Circle 360 program now recently unveiled. They talked about it actually in New York at their analyst meeting in February. And that's right now, I think, on promo for $50 a year. Normal price is going to be $100 a year, but it gives you free shipping, same-day shipping, in as little as 3 hours from any Target location. So I think that this type of membership program and loyalty program could help to ebb some of those market share losses and start to retain those customers and really high-value customers, because that $50 or $100 that they're paying on an annual basis, those revenues are pretty sticky. And they flow pretty nicely into the bottom line as you think about membership dollars, membership revenues over time.
Just quickly, it seems like a lot of businesses that have been kind of struggling with profits are turning to other businesses. Airlines are now credit card companies. Walmart is now a data company and an entertainment company. For Target, what's sort of the ancillary business that's going to prop up their profitability?
Well, there's probably two main vehicles that I would point to. The first would be advertising. So Walmart's ramping its advertising business. It's now over $3 billion. We estimate the margins on that are about 60 to 70%. And what's really interesting is you're taking a traditional retail income statement with sales of your inventory, less the cost of that inventory, minus the cost to pay your people, minus some benefits, and you're left with about a 4% operating margin. But you then combine that with this high margin recurring revenue segment that's 60 to 70% margins, and it becomes a really attractive story. And so Target has the membership program as well, in addition to that advertising, and we think that the mix of those two should help to support better sales and profits ahead.
Well, the stock is on sale this morning. It's down 7 to 8%. Corey, it's good to see you. Thanks for catching up with us. Corey Tarlowe there of Jefferies on Target. This from TJX just moments ago. The outlook for them, full year EPS, Lisa, $4.03 to $4.09. The previous range, $3.94 to $4.02.
And they are rewarded in response to upgrading some of their forecasts. We'll get to some of the commentary coming up.
Target getting absolutely hammered, down by about 7% in the pre-market. TJX doing okay. Coming up shortly, we'll catch up with Erin Browne of PIMCO, Vijay Rakesh of Mizuho, Jay Bryson of Wells Fargo, and Adam Posen of the Peterson Institute. All of that in the third hour of Bloomberg Surveillance, just around the corner.
How much has AI driven us? Where are we headed on AI? We get NVIDIA earnings. That'll be an important part.
AI at large is a macro story. NVIDIA is right now the cleanest, most direct way to trade that.
Investors have been looking for ways to play artificial intelligence, and they did that first with NVIDIA. I think there's more to go.
We're a believer in AI and believe NVIDIA remains the leader in AI.
All eyes are going to be on NVIDIA and what they say.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Two big stock stories. One this morning, one a little bit later after the close. NVIDIA, just hours away after the closing bell. We'll break down a preview for you in just a moment. What a run that name has had. Up by more than 90% year to date. A $2 trillion market cap moving that much is just unbelievable. Let's talk about a smaller company, but an important one. Target is down in the pre-market by about 8%, 7 to 8% through most of this morning. It's down 8.2. Currently, Lisa, the outlook from the company, it wasn't terrible, it wasn't dire, it just wasn't good enough.
Especially because of all of the doubts around this name anyway. I mean, to me, I think that we really just had a clinic in terms of how much share they've lost to Walmart at a time when they're facing a lot of controversies and execution questions. How do they revive that at a time where, frankly, all companies that face consumers are becoming something else? You have airlines that are becoming credit card companies, and now you've got retailers becoming media and advertising companies.
How to get an edge, and how important is that going to be when you have consumers saying that they are going to be more discerning on what they purchase? Corey, in the last hour, put it, the shifting of wants to needs. And I loved what Drew Matus said, a latte shock. That's what people are experiencing right now, and that's what's changing their decisions.
Andrew Hollenhorst of Citi taking some of these numbers really seriously. The communication coming from some of the retailers and what it could mean ultimately for monetary policy. He really believes that in July you get that first interest rate cut from the Federal Reserve. That's certainly not consensus, but the early signs he's seeing from retailers, he thinks up next a deceleration in jobs growth, and after that, the Fed's going to move.
And he thinks that the Fed speak that we've gotten so far is not necessarily preclusive of that July Fed rate cut. I will just say, maybe don't have a lavender latte and then you won't have a latte shock. Maybe don't charge $6 for a latte. $6 seems to be my line in the sand this morning for everything. And then you won't have a latte shock. The question that Andrew Hollenhorst is looking at is not the Starbucks and the Targets of the world. It's the smaller companies and how much they've already been struggling and flat on their back. And when that actually starts to show up in some of the unemployment numbers, that the larger cap companies that are doing just fine overall can't really paper over anymore.
I'm just trying to work out who you're angry with. The people who are buying the $6 lattes or the people who are selling them?
Yes. I thought it was
just
both.
Yes to both?
I mean, look.
People buying them. Are you going to lecture the kids about buying avocado toast? Is that what this is?
100% actually, because the markup on that is very big. Shrimp cocktail, the markup is always high. That's why when you go to a steak restaurant, they always offer that to you, and it's always significantly higher. Guacamole, always really high.
The path to becoming a millionaire by Lisa Abramowicz. Give up the latte and the avocado toast. Thank you, Lisa. And you can afford a house in America. This is what people with 2% mortgages tell you. This is where it comes from.
All right.
This is where it comes from.
Exactly,
people
that's
with 2% mortgages lecturing you on what to spend your money on because they got on the housing ladder at the right time.
Can I just say?
Lecturing you at home.
No, hold on a second. You can have avocado toast. Just make it at home. It's really easy.
That's
You
kind
just
of
take
you.
avocado, you go
Nice.
boop, 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 and you go toast it.
Lisa's going to let you eat at home. Good stuff. The scores look like this in the equity market. On the S&P 500, we're down by about 0.2%. The hate mail coming your way shortly.
It already is.
Yields are up by 4 basis points. It's a new privileged position of the older generation. They lecture you about what things cost because they've got a 2%, 3% mortgage. Your 10-year yield, 4.45.
So jealous, huh?
Would be great if you had savings and you could get that 4.45.
Yeah, it would be nice,
but you don't and you can't. In the FX market, the euro's at 108.28. We're negative by 0.25% on the euro. Coming up this hour, less of that and more of this. PIMCO's Erin Browne on potential outperformance in non-US equities. Mizuho's Vijay Rakesh previewing Nvidia's earnings, and Jay Bryson of Wells Fargo looking ahead to a September rate cut. We begin with our top story. The magnificent one is back in the spotlight. Nvidia reporting earnings after the close. PIMCO's Erin Browne saying this: all eyes will be on Nvidia. AI is everywhere, and a significant portion of tech capex is gearing towards this theme. While this is a relatively well-discovered theme in the United States, it is less so outside of the US. Data sovereignty will become an industrial policy tool. Erin's with us around the table. Erin, good morning to you.
Good morning.
Are you saying the bar's a little bit too high? Maybe valuations are a little bit too stretched stateside around this theme?
So I don't think that valuations are actually that stretched at this point. And I think that that might be a little bit of a shock to say. But at the same time, if you look at where NVIDIA is trading a couple of years ago, 3 years ago, it was trading at about 31 times. It's trading at that same valuation today. That said, there's a lot of attention with the stock up as much as it is year to date. All eyes have been on NVIDIA, and I actually think that there's opportunities outside of just NVIDIA to play the AI theme. And so I like looking under the surface at less discovered names.
Well, let's get to opportunities in a second. Let's talk about what people have been doing stateside. They've been looking to utilities. They're up 8% month to date.
Yes.
When we think about what's at risk a little bit later on this afternoon, is it just the semis, the chips, the whole of tech, or is it the whole of this market?
Well, so the utility names that have been really the ones in the firing line for people buying right now have been the ones that are more IPPs, that are more independent producers, that have the ability to really lean into the AI theme, and that's really brought the entire utility market up. I actually think this is one of the sweet spots of the markets. Utilities have been under-owned for a very long time throughout most of last year. They've underperformed pretty significantly. I think now with rates starting to peak and with the Fed likely starting to cut at least towards the latter part of this year, utilities look really attractive. That said, yes, if NVIDIA goes down today, the whole market's going down. I think that that's probably a short-term dip, and you likely buy, because right now it's just about playing the expectations of the rollout of the next chip and the GPU for NVIDIA versus what we know is going to be a very strong earnings picture over the next couple of years for the company.
I'm hoping Jensen Huang actually clarifies how you pronounce the name, because I hear people say NVIDIA and I hear people say NVIDIA, and it would be very nice for me to decide which one we're actually going to be talking about. You're talking about industrial policy fueling some of these ideas in terms of utilities, in terms of just industrial stocks more generally. Has that trade basically been played in the U.S.? And now it's really outside of this country that you're seeing new industrial policy put into place and not yet fully priced?
So the first answer is no, it has not been fully priced in the U.S. yet. With respect to the utility usage, the power usage, the water usage that's going to be needed to fuel the AI revolution that the U.S. is envisioning, it's going to require a lot more infrastructure and build out into really the picks and the shovels of the AI trade. Who's going to be providing the grid lines, the power lines, the water for the cooling? All of that, I think, is still very early stages. That said, while the U.S. at least has some focus on this sort of industrial policy going forward, you look at Europe and you look at outside of the U.S. and we're in very, very early stages. So I think we are likely to see a lot more investment and a lot more focus from a government side in terms of being able to provide the infrastructure in order to fuel the revolution that AI is coming.
Do you have any angst or concern that people are maybe getting a little too excited about Infrastructure Week on repeat? Just this idea, we were talking to Jack Caffrey of JP Morgan earlier this week, and he said it takes years to even get the permitting, let alone the actual picks in the ground. And people are using this as a play. They're using copper as a play, but we're not seeing the economic activity to back it up. It probably won't for a very long time. What's your fear factor with sort of overpricing at this point?
So I think that's a huge concern right now. I think that the market in some respects has run ahead of itself on the cyclical impacts that this is going to be, not on the secular. So I think they've probably front-loaded a lot of the performance. This is likely to play out over not just the next 3 to 5 years, but really over the next 10 to 20 years. And so, yes, I think that there has been a lot of optimism priced in the short end, but I think that you will see earnings continue to inflect higher. You are starting to see real ramps in some of these new chips, which are going to require a lot more power usage over the near term. And the challenge is that there's significant capacity constraints in terms of regulation hurdles in order to build out new power supply. And that's going to create, I think, keep prices elevated over the short term. But certainly there's a lot of sentiment that's positive right now. And so we're being very selective in terms of being dynamic in terms of how we're trading these stocks right now.
You like the United States, you're looking at Europe. What about Asia, where we see a lot of build out in the semiconductor supply chain and data centers?
Korea, we think, is a sweet spot for the markets right now. It's under-owned. It's been, bought in the last couple of months, but broadly underperformed pretty significantly vis-a-vis Taiwan over the last year or so. You're starting to see an inflection now in semiconductor exports that just went positive over the last 2 months coming out of Korea. We think that's a real sweet spot. China, we're cautious on still. Certainly, we're starting to see some signs of the tides turning. But we think that China's stabilizing, not necessarily growing. And so I think that creates a challenge for investors really meaningfully sizing their positions in China, just because the property market, we think, is going to continue to be a fairly significant overhang on overall GDP growth. Looking out 12 months, as you look across the world, who do you think has the most favorable growth policy mix right now? Who do you think it is? So I think that the U.S. still does, just because of the fiscal overhang is going to continue to create divergence in economic growth in the U.S. versus the rest of the world. I think you are starting to see an inflection and stabilization in Europe. And so that means, given how sort of under-owned and cheap Europe is, you can start to look back into European cyclicals in particular. But I think the U.S. by far is still going to be the outperformer with respect to growth. As that improves abroad, do you want to play that through bonds, FX, or stocks? You mentioned equities. What do I do with fixed income? So with fixed income, I think we like duration here, but really like European, UK, Canadian duration. We think that they're going to be much faster in terms of the cutting cycle, and probably more extended in terms of the cutting cycle than what's currently priced into market. Really interesting, when you look what's priced into markets right now across fixed income, they're all pretty much pricing in the same interest rate path. And so that to us is probably very misstated. Why do you think that is? I think historically you see convergence in terms of central bank interest rate policy. The Fed themselves are still expecting this to be a fairly normal Fed cutting cycle of 225 basis points between now and the end of 2026, with about 75 basis points of cuts each year. That's a pretty normal Fed cutting cycle. We expect that it's likely going to be more of a mid-cycle adjustment, and so you're going to probably see about half of those cuts than what the Fed is currently anticipating. And I think you're going to get some hint of that in the summary of economic projections in June. June 12th for the SEP and the Fed decision, same day as the inflation print. Erin, it's been too long. We haven't done this in person for years. It's good to see you. Thank you. Nice to see you too. Erin Browne of PIMCO there. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. As the market awaits the macro event that is NVIDIA earnings today, Apollo says that AI isn't going to provide as big of a productivity boost as many economists and companies have chalked it up to be. Its chief economist, Torsten Slok, spoke with me earlier on Bloomberg Brief.
The internet that came around in force in the 1990s, is that more important and has a bigger positive effect on the economy than AI? In economics language, is the productivity gains of the internet, are they going to be smaller than the productivity gains from AI? My opinion is that AI is not going to deliver the same productivity gains that we got from the internet in the 1990s.
He went on to add that the implication of that was that AI wouldn't be as large of an inflation dampening source as many expected to be, and that companies relying on AI to cut costs may disappoint investors. Barclays is the latest Wall Street firm asking its workers potentially to return to the office 5 days a week. Some managers have started warning employees to prepare for the commute daily, according to sources. The decision comes as FINRA announced a series of requirements that are set to take effect in the coming weeks. That includes requiring brokerages to list some home offices in regulatory records. And shares of Target are lower in the pre-market. Target said that it remains, quote, cautious on their near-term growth outlook and expects discretionary spending to remain under pressure. Executives said that consumers continue to search for value and are spending more on services and out-of-home entertainment, but are still cautious with their purchases. This week, Target announced that they would cut prices of about 5,000 items at their stores. And that's your brief, John.
Danny, thank you. Based on this morning's price action, Target up by about 9% year to date. We're going to erase almost all of that gain at the opening bell if these moves hold. The opening bell about 1 hour and 15 minutes away. Up next on the programme, the morning calls, and Mizuho's Vijay Rakesh previewing earnings from Nvidia. That's just around the corner. From New York, this is Bloomberg. The opening bell 1 hour and about 14 minutes away. Equity futures negative here by 0.2%. Some big movers out there, including Target. Target's down and down hard by about 8% through most of this morning following earnings from that company a few hours ago. In the bond market, yields are higher by 4 basis points on a 10-year 4.4512. Time now for the morning calls. First up, JP Morgan raising its price target on Macy's to 27. The analyst highlighting upbeat first quarter results and management's bold new chapter strategy. Next up, UBS lowering its price target on Lulu to 385. The analyst questioning whether North American sales growth is temporary and also noting slight downside sentiment. That stock is negative by 3.5%. And finally, Mizuho senior analyst Vijay Rakesh maintaining his buy rating and $1,000 price target on Nvidia, noting the chipmaker's continued AI leadership and looking ahead to the company's launch of its so-called super chip. Vijay, I'm pleased to say, is with us now for more. Vijay, let's talk about high bars, buddy. Beat and raise, and everyone's looking for the same a little bit later. Just how high is that bar for this company?
Thanks, John. Definitely, I think NVIDIA, the bar is high, expectations are high, but I think they will beat and raise again. We think 2024 will be another banner year. We think data center revenues for them in the 90 billion plus. So they continue to execute well. We think that 90 billion will grow almost 4x in the next 5 years to almost 280 billion in data center revenues by 2027. So,
Vijay, given how late they report in the quarter, and based on the fact that we've heard from Amazon, Meta, Alphabet, Microsoft, and they've told us their CapEx plans, and we understand they account for about 40% of this company's revenue, what isn't known about what they'll report a little bit later? What are you looking for? What's the new information?
Well, I think the big information will be on the ramp of the new products, the pipeline, how the pipeline of that is building. And I think as you go into 2025, the key for NVIDIA is they move away from doing just GPUs and compute trays to full stack servers. And that is a huge price ASP boost for them. So 2025 will be even a bigger year than 2024. So I think the best is yet to come, as they say. I think so. You are going to see a little bit more commentary on how the traction is on GPUs, on AI, how multiple industries passed beyond hyperscale into enterprise start to adopt this, how the DGX cloud is evolving, etc. So I think there's a lot more to come.
I've got to say, Vijay, that probably you hear a lot of people suddenly trying to become experts on NVIDIA today. One day, experts in artificial intelligence who understand very little of what goes into building out this system. There is a theory that NVIDIA's gain will actually diminish as you start to actually get true adoption and it moves more to the software and away from the hardware. How far away are we from that?
Well, I think they are very connected. I think for the software to work, you need a very robust hardware. And I think what NVIDIA did very smartly is build that CUDA software platform on top and then build the hardware under it. And so what they have done is a very good handshake between both the hardware and the software, which today is unparalleled in the industry. There is almost no other offering that can combine that much of hardware and software together. AMD is a very close second, but again, they have done very well on the hardware side. they probably have still more to do on the software side. So I think there's a lot more to go. I think what they have talked about for NVIDIA especially is a 1 trillion data center market today that will probably go to replacement. And that itself generates 250 billion of data center AI demand per year, plus in addition about 250 billion of greenfield capacity coming on. So that's about 500 billion a year on data center demand that they see coming through over the next couple of years versus, right now, this year, they'll do about 90 billion a year. So definitely good, strong roadmap there.
Do you expect any commentary from NVIDIA around some of the heightened rhetoric geopolitically around chips, the sector, questions around Taiwan and its resilience as the main production area, and how they're planning to diversify just in case?
Yeah, this is a very touchy topic. Obviously, Taiwan is a big, is where a lot of the AI servers, GPUs come out of, 90% plus. So that's definitely a hub for the manufacturing side. But in terms of exposure to China itself, that's been minimized significantly, right? I mean, if you look at NVIDIA's revenues, China is mid-single digit or even lower. But the geopolitical threat is there, the risk is there, and that's just not limited to NVIDIA. That's probably related to all semis. And that, when you talk semis, that probably impacts all industries. So it goes way beyond NVIDIA, and we'll probably cross that bridge when we come to it. But it's definitely a risk that is worth noting that I think everybody is taking cognizance of. So.
And the NVIDIA CEO spoke about that, the reliance on Taiwan, and that's going to be the expectation for the near, short term, and really long term. But when you think about that and they start to build out, potentially leaving that as a smaller hub, where would they go?
Yeah, I think we should start to see some of the manufacturing obviously move back into the U.S. You are seeing TSMC start to build out in Texas, Phoenix. You're starting to see Samsung build out supply chains in the U.S. Obviously, Intel has made a lot of moves trying to build out the foundry side. So there is a very strategic move trying to push that center of gravity from Taiwan back to the U.S. or at least split that. Have a barbell approach there. So it definitely takes time. It's not a 1 year, 2 year thing. It probably takes multiple years. But by far, I think TSMC is in the lead. And the fact that TSMC might start to build out the leading edge hub in the U.S. should be positive for the AI or in general, the semi supply chain. So,
Vijay, I'm going through the companies that fall under your coverage. I believe there are 27 of them. I see a lot of green buys, particularly for the semis. And then a couple of things stand out. In fact, 3 do. NIO, neutral. Tesla, neutral. Rivian, neutral. What's going on there, Vijay?
Yeah, I think, thank God we had a lot of buys because semis have done fairly well. But I think back to the EV question, I think what you're seeing on the electric vehicle side is demand starting to slow down a little bit. A lot of the first wave of buyers have gone through it. And now what you're seeing is a little bit of slowing down on the EV demand in 2024. And that is primarily because a lot of the subsidies globally have been sunset. Germany took out subsidies, US took out subsidies. At the same time, pricing has been pretty high. Interest rates have been high. So those have not really been conducive to driving EV demand. And I think that combined with most of the OEMs like Ford, GM have pulled back on their EV strategy. You're seeing OEMs in Europe as well push out their EV ramps. So it's been a combination of OEMs not seeing the desired level of profitability, consumer subsidies being sunset, and at the same time, in general, EV demand kind of maturing a little bit in the near term. The next round of EVs obviously will need lower pricing to stimulate that demand, and that will obviously come at a price. It'll be at a lower margin for the supplier. It'll be much more competitive, and so I think that is always a challenge.
What do you make of the tariff war that's emerging, the threat of tariffs coming out of China, not just Europe? Will these companies have a global market to sell into, or just increasingly one market, a domestic one?
Yeah, I think, the threat from China EVs is very real. I think when you look at BYD, which is a very dominant and very competitive supplier, they can do EVs at $10,000 to $15,000 versus, many of the EVs in the US start at $25,000, $30,000 plus, going all the way up to $80,000. So the China supply chain can be very competitive, but today their footprint is very small. So, going from 50 to 100% doesn't change the math a lot because they don't really ship a lot into the US, but it is definitely a very competitive market. And any entry into the US would be very very challenging for the existing OEM suppliers.
Vijay, before you run, can you set a debate for us? Is it NVIDIA or NVIDIA? Which one is it?
N as in just put the letter N and then NVIDIA. There you go.
NVIDIA. Thank you, sir. Vijay Rakesh. Appreciate it. Adam Mizuho on the latest. That clears it up, right?
I really appreciate that. That was actually incredibly helpful because when people say NVIDIA, I'm always wondering, do I say it wrong every single time? Have they established that it actually is NVIDIA?
If you ask me, I'd forget how I say it.
Like you say NVIDIA, you say NVIDIA.
Okay.
Erin Browne said NVIDIA. Everyone else says something different.
Okay, given the importance of this stock, you'd think we'd agree on this stuff, right?
I mean, that's what everyone disagrees on.
That
it's
stock
stuff.
is positive by 0.1% in the pre-market. Coming up shortly, conversation you do not want to miss. Jay Bryson of Wells Fargo alongside Adam Posen of the Peterson Institute. We'll talk to him about the economy and the Federal Reserve, and then we'll get into trade with Adam a little bit later in the conversation. From New York, this is Bloomberg. $60 minutes away from the opening bell. Equity futures on the S&P 500 negative by 0.2%. On the Nasdaq, just about unchanged throughout most of this morning after closing yesterday at another all-time high in the Nasdaq 100. The 24th record close on the S&P of the year so far, a third day of gains. The fate of the week, I guess, in the hands of NVIDIA. That's coming a little bit later. We'll talk about that again in a moment, no doubt. Let's turn to the bond market. 2-year, 10-year and 30-year. Yields are higher, creeping higher, just pushing higher now by 4 or 5 basis points on a 10-year. 445.71 on a 2-year, up by 4 basis points at 486.90. And setting the tone for this, just a little upside surprise on inflation out of the UK. Putting a floor under sterling through most of this morning, Browne, and raising a prospect that maybe that first rate cut from the BOE gets pushed back into later this summer.
Yeah, this is the confusing part. It's the when they start the rate cuts, not whether they will start the rate cuts. In the U.S., there seems to be a little bit more of a debate over whether they need to cut rates at all or how much they have to. In the UK, it's just a matter of timing. So it sort of is unfortunate for them and raises this question, at what point will that become weakness for the currency? Because that means less strength because they have to hold rates higher for longer. I'm just saying that could be one of
In Europe, apparently, we're not debating either. They're just going to cut interest rates next month. It's done. Basically, according to communication, there seems to be some separation on whether you flag July. So it'd be interesting to see what the news conference looks like with President Lagarde in about a month's time. But the decision, I think everyone's on board. Rate cuts, let's go.
I mean, it's kind of refreshing, and they've kind of gotten a pass from the market. So they can launch that at a time when they're seeing real economic weakness, some serious policy divergence, some real questions in Germany still. I mean, you'd have to think about the idea that they're thinking about tariffs on Chinese cars, then the reciprocal tariffs. How are they going to deal with that? I mean, a rate cut kind of, eases things.
Got these sort of structural growth model issues in places like Germany. What's the future look like? But the growth policy mix in Europe does start to look a little bit better. You think about those recessions in Europe, we can't cut interest rates, inflation stubbornly high, we need to keep rates up here. Now you're in a position where the economy starts to show signs of life, they start to reduce interest rates. The mix of things just starts to improve. I know it was a super low bar, but it's getting a little bit better.
Are you looking to buy housing there or something?
In Europe, specifically?
Yeah.
In Italy, possibly? I mean, I'd love to.
I mean, are you just basically making an argument?
My personal bias would be to make an argument that Europe's dreadful and to
I was just about to say, what are you doing?
Sell off even more.
You're basically making the argument a lot of people
But I don't have a bias, and the euro's at 108.30, and it's negative by, what are you laughing at? It's negative by 0.2%. Under surveillance this morning, the latest Bloomberg Morning Consult poll showing that half of the swing state voters are worried about violence following the election. This is presumptive GOP nominee Donald Trump leads across key swing states, including Michigan and Wisconsin, which President Biden won by narrow margins in 2020. Meanwhile, 51% of respondents also support a US ban of TikTok. We polling this now, championed by Biden if its Chinese parent company fails to divest.
When it comes to TikTok, though, it's because of what they think it's doing to the brains and minds of young Americans, not so much the concerns about foreign data and national security concerns. What stood out to me in this poll is the economy still maintains number one. Listen to this question. When thinking about the economy, which of the following factors are most important to your vote? The cost of everyday goods, 63%. That's when you have the likes of Target, Walmart coming out and saying we are seeing a little bit of cracks in the consumer. They're trading down. This makes sense because our polling shows the economy's number one concern, and high on the list is inflation.
I just have to wonder if the Biden campaign looks through that and says, okay, so student loan relief for you, free pot for you, TikTok we're not going to ban for the foreseeable future. It's sort of how much can you play whack-a-mole politics before it doesn't actually work? I don't know. I mean, this sort of seems to be always the policy.
It's election year. Stay tuned. There's more still to come. Let's turn to this one. NVIDIA. Did I do that right?
You did so well.
NVIDIA earnings coming after the closing bell. Investors will get fresh insight into the AI spending boom thanks to the chip giant's outsized role across the tech sector. The results are expected to confirm enthusiasm for AI growth and big tech's earnings boost for the major indices. It hasn't just been tech that's rallied. It's been utilities as well, which are up about 8% month to date. Lisa, you got into this with Mike Wilson. I've been thinking about the same thing. We talked to someone earlier this month about it too. If utilities have been rallying for more offensive reasons, what kind of risk mitigation characteristics do they have in a downdraft if that downdraft is led by disappointing AI numbers like NVIDIA a little bit later?
I think you asked it, are they growth stocks or are they safety stocks? At this point, if they're basically an AI play, and have we gotten a little over our skis in thinking that we're going to get all the permitting, et cetera, to have all of those utilities built up? I don't know the answer to that. Erin Browne said there's still value there. There clearly are other people that see value, and maybe it doesn't really matter if other people see value. You can ride that momentum for the foreseeable future.
Favorite quote of Mike's yesterday, that AI was everywhere except in the numbers. With the exception of like NVIDIA and some other names as well. We're thinking about utilities, all these second derivative themes that Jack Caffrey of JP Morgan was talking about.
I want to know the first derivative. I want to know if Target is actually using artificial intelligence to remove some of the potential shifting in whether you get certain products that you actually want. I mean, I'm looking for actual efficiency and whether they actually start to come through in the numbers.
I was struck by what Vijay said. The best is yet to come when it comes to NVIDIA, and that doesn't even mean this year. 2025, 2026.
Which is amazing given the gains we've had so far year to date and over the last couple of years as well. Just incredible. Let's get to this. This week's Fed Speak parade winding down. Thank goodness. Fed Governor Christopher Waller saying softening data in the next 3 to 5 months could allow for a cut later this year. Fed Presidents Mester and Collins also urging patience, reinforcing higher for longer. Their comments coming ahead of the Fed minutes at 2 p.m. Eastern Time. To break it down, two of the very best, I'm pleased to say. Joining us now, Jay Bryson of Wells Fargo, alongside Adam Posen of the Peterson Institute. Jay, can I come to you first, sir? I want to get your review of the assessment from Governor Waller just yesterday. Given that inflation print from the last week or so, a C+ grade, would you give it the same grade?
B-, C+. The good thing is it's coming down, right? And I think we're going to continue to see that as we go forward. The big sticky part here has been the service sector sort of inflation and what we know about the leading indicators of housing prices. If you look at what's happening in rents in the economy, you're going to continue to see disinflation there. And then when you look at wage growth, we saw this in the average hourly earnings print earlier this month. Wage growth measured by average hourly earnings only up 0.2%. If you look at that and you annualize that over the last 3 months, we're below 3% right now. So all that's pointing in the direction of inflation continuing to recede as we go forward.
Adam, to Jay's point, is there evidence building that things truly are downshifting?
Not really. We hosted Governor Waller yesterday for the speech, and I think what was striking, John, was that he was trying to put a dovish spin on what was actually a pretty hawkish message. He basically said, I have to see real slowing in the U.S. economy before I want to cut. And he ridiculed the fact, I think rightly, that, they're parsing now the second decimal place on the inflation print, which I thought was very well taken from Chris. So I think the message is, no, they don't want to admit that there's a possibility they'll have to hike, but they are backing off cutting.
I love this. Fed Speak is a Rorschach test, because earlier we had Andrew Hollenhorst saying that it was really a dovish message under the hood because several could mean anything. You're saying that it's a hawkish message. Are you getting anything from some of the commentary, considering that it really is sort of a choose-your-own-adventure, Adam?
Well, I watched before I came over this morning, Lisa. I saw Andrew, and like me and Andrew, we've been both on the same side on the Fed, calling that they were going to hike a lot and then calling they weren't going to cut a lot. And this is my first divergence with him in a while. I think you look at Mester, you look at Collins, you look at Bostic, you look at Waller, you look at all this Fed speak. It's all back to Phillips curve. It's all back. Even Chris, who was the one who said you could have disinflation with vacancies dropping, no unemployment rising. And yesterday he made very clear that at this point we're back on the flat part of the beverage curve, and you would have to see unemployment rise. So I don't view it as dovish at all.
Jay, why do you sort of, maybe disagree, or would you push back at all, saying that actually there still is room, especially if you get weakness maybe in the labor market?
Yeah, I certainly think that's true. I mean, things can fall apart really quickly. And I'm not suggesting that's going to happen, but you were mentioning just earlier, when you look at Walmart and some of those other retailers, you're starting to see cracks in terms of the consumer. And delinquencies are going up. Monetary policy right now, measured by conventional sort of measures, real monetary policy, real rate, still remains restrictive. And so I think you will see continued slowing as we go forward. Now, certainly not looking for a rate cut anytime soon. I think the Fed is going to hold the line on that and make sure that we're coming back to 2% on a sustained sort of basis. But things can downshift here pretty quickly as we go forward, and particularly is what we're seeing in terms of the consumer right now.
Adam?
Yeah, I mean, Jay, I know well, and he's making a legitimate point, but I think downshifting in the consumer after the run of the consumer, the NVIDIA-like run of the consumer for the last couple of years, is not necessarily portending. In fact, is very unlikely to be portending a massive downshift. But more importantly, what the Fed's not allowed to talk about, but you here on Surveillance and I and Jay and everybody can talk about, is what happens after the election, right? You were talking a minute ago, Lisa, about whack-a-mole and targeted policies, right? So what happens after the election is probably we get fiscal boom, particularly under Biden. And if it's under Trump, we get a huge energy shift towards go, drill, baby, drill, and internal combustion engines. Either way, you're going to get probably an unsustainable boom in 2025. And I think the Fed's going to have to start raising.
You think they're going to be hiking interest rates again next year?
Yeah.
Really?
Very reluctantly.
How quickly? Yeah. And what's the lesson, say, of 2016, 2017, when we were all waiting for those tax cuts? The Fed knew they were coming, but they couldn't change their plans until they actually saw them. Is that a decent experience?
I think, John, that's a relevant example. I mean, because they supposedly the taxes from 2017 are going to expire by the end of 2025. And depending on who's in Congress and who's in the White House, there'll be a very protracted, messy negotiation. But if you're Biden, you have to spend more on defense, you have to spend more on energy, you have to keep spending on the industrial policy. If you're Trump, you're busy pushing out deregulation, tax cuts, whatever it is. Both of them are pushing towards a very big fiscal swing. And whatever result we get on the taxes, it's by the end of 2025, it's not going to be tax rates jumping up.
I'm so pleased you've brought this up because I do think we're flying blind into 2025. I get the same feeling. And you're the first person really to come on this programme and actually sort of lay out what you think is going to happen and why you think the Federal Reserve is going to have to hike interest rates. Lisa, I've not heard that before on this show at all.
I got something to talk about.
Well, yeah. I mean, I'm sitting here thinking to myself, if you have a boom on top of what we've already had, that's a real boom for stocks and a real negative for bonds. Jay, what's your reaction to that?
Well, so what I would say is, we're talking about President Biden, we're talking about potential President Trump. It's really going to depend on what the congressional makeup looks like as well. And so in order to get those big fiscal swings, you pretty much need to have Congress and the White House kind of aligned. And if we have a split decision come November, and nobody knows what's obviously going to happen, but we'll see what happens there in terms of fiscal policy. But between now and the end of the year, I mean, we're still looking at 5 months away of that, and I could potentially see a lot of downshifting here in terms of the economy, and potentially you could see some Fed rate cuts at the end of the year. But a lot of it's going to hinge, as Adam points out, a lot of it's going to hinge on what happens in the election, and again, what the election outcome is in terms of not only the president, but in terms of what the congressional makeup looks like as well.
Jay, as John was pointing out, it's very hard to have any visibility whatsoever into what's going to happen. Adam makes a very compelling case for why either way you'd get a fiscal boom. Either way, though, why would the Federal Reserve want to cut rates ahead of that, knowing that there could be some upside that could force them to reverse course?
Well, again, I'm not looking for them to cut rates anytime soon. I mean, I think the potential earliest you would see a rate cut, and depends on what's happening with the data between now and then, would be in September. The election obviously complicates that a little bit as well. There's another FOMC meeting right after the election, 2 days after the election. Do they cut rates there? I mean, that's going to complicate things as well at that point. But they're really going to have to see how the smoke clears. And again, because you're going to potentially get a fiscal boom, it's not going to happen right away. I mean, and so this is going to be legislated sometime in 2025. We're still at least a year out from things being legislated, and the Fed will be responding to where the economy is at that point in time.
Jay, I'm glad you brought up Congress. Adam, this kind of idea you have about the Fed having to hike because of this fiscal spending is dependent on the makeup of Congress. Biden, if he was going to spend like that, would need a Democratic House and a Democratic Senate, correct?
Yes and no. Annmarie, you're absolutely right, but I think less so than in the past, because remember two things. First is that the bills already passed in IRA and CHIPS, they're mostly open-ended subsidies. They do not require reauthorization from Congress. They can be interfered with if Trump comes in, but that spending goes. Second, that the defense spending generally gets taken out and voted on separately, and often bipartisan, or at least more bipartisan. So I think two of the big places where you're going to get spending are not going to be subject to withholding by even a Republican Senate the way it might have been in the past.
Interesting. Jay, I just wanted to come back to you on this downshift that you're looking for. I'll ask you the question I asked Andrew. Can you put some numbers on it? With a 3-month rolling average on payrolls north of 200K, what are you expecting to see later this summer? What does that come down to? Andrew said sub 150. What are you looking for?
Yeah, we're looking for roughly the same. I mean, if you look at our average for the third quarter, I think we're looking at 150 and then slowing to roughly 120 or so by the fourth quarter of the year. And we're also looking for the unemployment rate by the end of the year to be up to 4.1%. You know, and if you believe in the Psalm rule, if you get up to 4.1%, then the economy should be tipping into recession. Now, we're not looking for that, but we are looking for sub-trend economic growth later this year. Print of, less than 2%, not being dragged down by inventories, not being dragged down by a big import surge, being dragged down by downshift in consumer spending, and as well as investment spending that is lackluster at best.
Jay, this was great, super thoughtful. Jay Bryson there of Wells Fargo. Adam Posen of the Peterson Institute for International Economics still with us around the table. Adam, I wanted to save some time to talk about trade.
Yeah,
You've got some really strong thoughts on this, and I think it's going to be a valuable portion of this programme this morning. Do you think we're turning our back on economic liberalisation at a time when global challenges actually could benefit from it?
That's a great big picture question, John, and I appreciate the fact that you and Lisa and Marie keep coming back to this. It is a huge shift, whether it's Biden or Trump. Biden, I think, is drawing the line at some of the most crazy Trump tariff policies that are proposed, but he's done nothing to reverse and now added on some. There's an anti-China element, which has national security overhyped, but there's more about what this does to U.S. relationships, business relationships, technology, market opportunities, investment flows throughout the world. And we've been writing on this at Peterson Institute. We just published 2 days ago a great new piece by Kimberly Clausing and Mary Lovely on how the proposed Trump tariffs would be a huge hit to middle class and especially working class families. So what they did was they looked at the proposals through the lens of being taxes. So you had David Malpass on talking about tariffs as taxes, which they are. And so they use the same apparatus people look at tax increases for what's the incidence, meaning which parts of the income distribution get what and lose what on net. And the average American household would lose $1,700 a year if the Trump tax cuts went through. If the Trump tariffs went through. And the distribution is highly regressive. So even if you continued the tax cuts from 2017, you would still on net be hurting the lower 10, 20% of the income distribution even more. And this just goes to what you were saying, Annmarie, about how purchasing power of households, feelings of inflation, feeling of high prices, which sometimes gets muddled, but anyway, is really core. And so Biden could make that better by cutting tariffs that were left to him by Trump that are not national security, not China. He could do it through executive order, boom, increase people's purchasing power. But the worst thing is if they go crazy, as convicted felon Peter Navarro said in an interview, that this is the policy that Trump's going to do. If they actually do the policy they say they're going to do, they're going to cost American households.
We had David Malpass on. You referenced that conversation, and he was saying that lower taxes and targeted tariffs could be a growth policy that will actually get the U.S. to a place that could allow the deficit to be manageable. Do you agree?
No. That's essentially what the right-wing populist governments tried in Latin America in the 70s, 80s, and 90s, and it was a huge anti-growth policy. There's a reason the World Bank, which David used to run, has recommended against that for development for millions of people around the world. It's taking the U.S. into banana republic territory. It is revenue positive for the Treasury. I mean, that is true. But when you're choosing how you're going to raise revenue, it's one of the most distortionary ways to raise revenue with the most negative impact and the most intrusiveness of government. And mostly when people like David Malpass and others talk about the advantages of tax cuts, it's about getting government out of business's way. Tariffs are the most intrusive way you get government into people's decisions.
Unlike concerns that you have about a fiscal boom next year, which is reliant to get a lot of those things you're talking about, the makeup of Congress, Trump could come in and edit tariffs immediately.
Yes.
So how inflationary can those be that the Fed needs to start thinking about within days of a potentially Trump 2.0?
You're right to raise it, Annmarie, and I think that's a key point, that both Biden and Trump, but especially Trump, is able to do a lot of stuff through executive order. So he can change migration policy through executive order. He can raise tariffs through executive order. He can bar foreign direct investment through executive order. He can change energy regulations through executive order, all of which is boom. And the levels of inflation we're talking about, if he does that, we're about to release some studies of this later in a few weeks, I hope. But, you know, order of magnitude, you see a jump in inflation, 1 to 2% immediately just on the tariffs alone. If you do the kind of crazy, inhumane migration deportation policy they're talking about, we're seeing much bigger numbers because you're completely disrupting labor markets and causing shortages of certain types of labor beyond the human cost. And creating huge uncertainty for small business. So you're looking at very large jumps in inflation, and the Fed may not want to explicitly address that because it's seen as political, but I would put the odds of them being able to do the cuts in 2025 is very low.
Wow. We're going to have a lot to talk about this year. Look forward to covering it with you. Adam Posen there of the Peterson Institute for International Economics. Equities at the moment just a little negative on the S&P 500 with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel has recalled its ambassadors to Ireland and Norway after the countries announced that they would recognize a Palestinian state. The coordinated move, which was soon followed by Spain, underscores how the war in Gaza is focusing global attention on the issue of statehood for Palestinians and hurting Israel's relationships with other nations. Donald Trump's defense team has wrapped up its case without calling the former president to the stand. Closing arguments in the hush money criminal trial are set to begin next week. Meanwhile, lawyers in the classified documents case are due in court today for the first time since the judge indefinitely postponed the trial earlier this month. The judge is scheduled to hear arguments on a Trump request to dismiss the indictment on grounds that it fails to clearly articulate a crime. And TJX shares rising this morning, nearly 2% in the pre-market trade. The company raised its outlook for next year and reported net sales, which met the average analyst estimate. The companies under the banner also saw a decline in merchandise inventories. A statement went on to say that comparable sales were up at every division, which, quote, underscores the strength of our value proposition. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, setting you up for the day and week ahead from New York. You're watching Bloomberg Surveillance. About 36 minutes away from the opening bell. Here's the trading diary for the day ahead. At 2 p.m. Eastern Time, we'll get the minutes from the last Fed meeting. After the closing bell, Nvidia reports earnings, and tomorrow, another round of jobless claims. I think I always said it that way.
You did.
Nvidia,
you always said it right.
Okay. Just confusing stuff, right? That's the big one after the close.
I just hear different ways.
Can we pick up on the conversation we just had with Adam
Please.
Posen at the Peterson Institute? Setting the stage, not for cuts. He's talking about hikes in 25 off the back of the election in November.
You have to think about whoever's going to come to office is going to want a stimulative policy. Everyone has come on and said that there is no hope of any kind of fiscal retraction, regardless of who wins, which raises the question, what is the potential risk to both inflation as well as to the Fed's outlook and they're being forced to respond at a time where there still is already so much growth and still they're talking about rate cuts?
When it comes to the fiscal spending, which Adam Posen was talking about, whether or not it's Trump or Biden, tax cuts come to mind. and tariffs. But for things like tax cuts, defense spending, you need to have Congress lined up with the president if you want a full sweep, something like potentially what Biden could do. He would need a Democratic Congress to go along with him to infuse more money into the system. Gridlock in Washington means there's going to be less fiscal spending. When it comes to tariffs, though, to Adam's point, that could be done almost immediately, whatever the president is.
We'll spend the rest of the day, no doubt, talking about NVIDIA reporting after the close a little bit later this afternoon. We should. We'll pick up on that story tomorrow morning. But the quote of the last 24 hours came from Mike Wilson of Morgan Stanley off the back of his recent big upgrade. When we asked him about the risk in equity markets, it wasn't about earnings. It was about the bond market. It was this line here. The risk in the story for the next 6 to 12 months is, do the markets start to bulk at this unsustainable fiscal policy? And Elisa, that's the risk right now, front and centre, going into November.
And what's shocking to me is the divergence in what could create that shock. You have David Malpass saying that actually tax cuts and targeted tariffs could be beneficial and help the deficit. You've got Adam Posen saying absolutely not. There's complete disagreement, not only of the outcome, but what the implications would be.
I've got Steve Eisman on my shoulder laughing. Boy, the deficit.
He's rating
those people
shows.
who have been wrong for 40 years. I hear you, Steve. Coming up tomorrow, here's the lineup for you. Sarah Hunt of Alpine Saxon Woods, Ashok Bhatia of Neuberger Berman, Sebastian Page of T. Rowe Price, and Dana Peterson at the Conference Board. Looking ahead to NVIDIA earnings later on from New York City. Have a wonderful day. This was Bloomberg Surveillance.